push on those costs. But in a world without the Fed moving, right, like the Fed can make it more expensive and can take, particularly how the durable goods, which consumers often need to borrow to make it happen. Yes, the Fed can bring demand, cool it off some. That is what's happening. It's sad because the real way to fix inflation, and Jay Powell said this, is to get us out of the pandemic. But I think, frankly, listening to President Biden last week, this is not going to happen. So the Fed is going to have to cool off demand.
Claudia, an unfair question, and this goes to fancy mathematics, which gives us beautiful curves that we never read in Michael Woodford's book on interest and prices and their Euler functions. I don't want to go into it. What I do want to say, Claudia, is there's all sorts of lovely curves that get us back to an inflation rate. Where is your image of where that new inflation rate is? Is it 2%? Is it Adam Posen's 3% new inflation rate, or is it a number that's higher but not frightening? Where does inflation settle out at on the glide path?
Yeah, so first of all, I just say every single one of my forecasts about where inflation is headed, and this has been true now the entire pandemic, is when the pandemic moves into an endemic and we really have this under control, then when that happens, we're talking another 6 months of getting us back to something that's really close to 2%. The longer this goes on, the harder, the more backup we have, the more things have gone haywire. But the fundamentals in the US economy are not notably worse, and that's a lot of the response last year. Is just we have this other factor that is, until the pandemic is under control, we are going to see well above 2%.
Claudia Sam.
But not 7.
Of the James Family Institute. I think we all hope it's not going to be 7. Claudia, thank you for joining us. Tom, looking at the glide path going forward from here, the runway for CPI and the ECFC screen on the Bloomberg. These are the estimates that we gauge from the analyst and economics community. 4.8% for CPI 22, Tom. 23, 2.4.
Yeah.
23, 2.4, and that's going to be the hope. And I raised this question yesterday going into Chairman Powell in the news conference tomorrow, because I think, Tom, it's going to be an important one. Has this chairman given up on the essence of transitory, even if he's given up on the word? And I don't think he has just yet, Tom.
I agree strongly with that, John. And frankly, folks, what is it, EFCF,
ECFC?
I can't remember. Whatever the function is, we used it yesterday to show what it means for the animal spirit and a phenomenal GDP to come in. And I agree, John, that glide path, if you extend it out in an imaginary state to 2024, gets you to a successful Fed policy. And that's what they're betting on. And that's why transitory, perhaps, is still in play.
That T word, Lisa, winds up everyone. And please, you can have your own debate on it. This is the chairman. I think we need to get our hands around what the chairman thinks about the situation, Lisa. He buried the T word. I get that. But when you listen to the core of the committee, they still believe that inflation fades going through the middle of this year. Does it fade enough that they can back away from these calls for 4 interest rate hikes and a whole lot more?
And the reason why, let's just be very clear, the reason why they backed away from transitory is because it's very clear that some of the transitory aspects of inflation have fed into consumer expectations for inflation, have fed into wages, have fed into some of what we're seeing. So it's got a self-fulfilling prophecy because it was dragged out for so long. Then you've got the Omicron disruptions, zero COVID policies in China that are going to continue some of these delays. How long does it take before it becomes damaging and the path of getting to that lower rate of inflation becomes really catastrophic for certain pockets of the economy?
For some people, Lisa, we're already there. I think for some people it's clear that it's already embedded in long-term expectations. I stress for some people because this debate remains open. And for some people, they think it's too late for the Federal Reserve to engineer a soft landing because of that.
And that's why I say it's the path. Do they have to hike rates quickly to get back down to that low pace of inflation? Or is this something that can be perfect Goldilocks, threading the needle?
The Fed's still doing QE. I think that's worth repeating when we see NASDAQ futures now down to 1.8%. And the S&P down 1.25.
I don't even want to go there, John. Ask me at 3 p.m.
Exactly. Futures are negative from New York City with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. This is Bloomberg.
With the First World News, I'm Ritika Gupta. President Biden had what he said was a great call with European leaders on coming up with a unified position on Russia and Ukraine. He tweeted that they discussed joint efforts to deter further Russian aggression. Meanwhile, the US says that as many as 8,500 troops could be sent to Eastern Europe to help bolster NATO forces. Another missile test from North Korea. Kim Jong-un's regime appears to have fired 2 cruise missiles towards waters off its east coast. North Korea has test-fired more missiles this month than at any time since August 2019. It's also warned the U.S. it might end its 5-year halt on tests if nuclear devices and the long-range missiles to deliver them. Workers in the UK will need an average 8% pay hike this year to offset the squeeze from higher energy bills, tax increases, and broader inflation. That's according to the Tony Blair Institute for Global Change. The institute says the poorest 1/5 of British workers will need double-digit pay hikes. Hedge fund billionaire Ray Dalio warns that there's a reasonable chance neither U.S. political party will accept the results of the 2024 election. He also says the U.S. is in relative decline while China has been rising. Dalio spoke in a wide-ranging interview for the David Rubenstein Show. That will be broadcast February the 2nd on Bloomberg Television. And an heiress to the Walt Disney fortune says consumers can skip visits to theme parks if they want to help workers' rights. Abigail Disney is a longtime critic of work conditions and low pay at Disney. She spoke out after screening her documentary at the Sundance Film Festival Monday night. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lines from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
that capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
One of the challenges we have, I think, is finding that new normal where people really feel comfortable, because you run the risk that you say, okay, we're going to be fine doing A, B, and C, and half the people think that's too restrictive, and half the people think that's not restrictive enough, and nobody's happy.
Nobody's happy, isn't that the problem? Joshua Schaafstein, Johns Hopkins Bloomberg School of Public Health Vice Dean. From New York with Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. Here we go again in this equity market. On the Nasdaq 100 down by 1.9%, on the S&P down by 1.3%. The turnaround yesterday just absolutely humongous. Down almost 5% at the lows on the Nasdaq, then positive 0.5%. Yields a bit higher today on 10s, much higher on 2s. On 10s, 177.60. Crude advances again of 5 or 0.6% to 83.77. Bit of news from Pfizer, Tom. Our reporter Riley Griffin writing this one up. Pfizer said it's starting a study of COVID-19 vaccines that target the Omicron variant, exploring its use in previously vaccinated younger and middle-aged adults, as well as those who haven't received another coronavirus shot. Pfizer down by 1%. BioNTech, Tom, down by 0.5%.
If you're confused, we're confused. And it's not about the markets. It's about this pandemic. And from sea to shining sea, all 50 states, there seem to be 50 different approaches. Amish Adalja joins us now, senior scholar, Johns Hopkins Center for Health and Security. Amish, define endemic for someone in New York, or I'll name another endemic worried state that has 3 masks on and is living in a bubble and afraid to go to a restaurant, or somebody in another state where there's no mask, no nothing. They both have endemic. What is endemic in those 2 different states and from coast to coast?
What endemic means literally is with the people. So this means that this is an infectious disease that is part of everyday life, that it's sort of the trade-off you pay to live in civilized society where there's going to be social interaction. And with endemic diseases, what we see are ups and downs. We see a baseline number of cases, hospitalizations, and even deaths. We see flares that may occur, but what we don't usually see are hospitals going into crisis. So that's the remaining kind of pin that needs to be put into place, is that we get our hospitals fortified because enough high-risk people have been vaccinated, or we have enough tools like Paxlovid. But when you're dealing with an endemic disease, each person's risk tolerance is going to dictate how they navigate a world with it. Just like there are people that are more or less afraid of influenza or take more precautions in flu season than other seasons.
Do we need masks if we're fully vaccinated? Do we need plastic cubicles if we're fully vaccinated? Do we need to work from home if we're fully vaccinated?
My answer to that is no, because you are then protected against what matters: serious illness, hospitalization, and death. But there are some people who want to be protected against even mild disease, which I don't think is really possible with a virus like COVID-19, because it's going to become endemic, because it's going to become unavoidable. The goal is to shift its spectrum to mild illness. But there are going to be many people who want to continue to wear masks, who continue to want to have high levels of protection. But I think eventually COVID-19 is going to infect them if they have social interaction. And that's the difficulty, is that people have different risk tolerances, and our society is kind of not deciding which way they want to go. And that's why organizations have people still working from home, where there's a lot of restrictions in place at organizations, as well as at universities. Universities are probably the worst example of this, where they can't find an off-ramp to dealing with this the way they deal with other respiratory viruses. And indeed, that's the way the policy is going from the administration, dealing with this like other respiratory viruses. And this is something we should have done much earlier.
Dr. Adalja, given the endemic nature that many people are talking about, how important is it that Pfizer and BioNTech come out with some sort of COVID vaccine targeting the Omicron variant?
We have to continue to improve our vaccines. We're still using a vaccine targeted towards the Wuhan strain of this virus, and we know that it's become less effective as we saw Delta, as we saw Beta, and definitely as we saw Omicron. I think it becomes less and less tenable to keep using the same version of the virus. It's true that the vaccine is able to protect against what matters, serious disease, hospitalization, and death. But if people are worried about infections and trying to get cases down, then I think a better targeted vaccine makes sense. However, it's only going to come after the brunt of Omicron passes over the United States and passes over the world, so it may be less effective. But it could be the case that this type of updating would be useful if new variants emerge out of the Omicron lineage or are related to Omicron, and it gives more protection. But I think we have to start thinking about better vaccines, more universal vaccines, vaccines targeting variants, if we're going to have a sustainable approach with using vaccines and get people confident that they can go about their lives.
To that point, Dr. Adalja, how much were you encouraged or discouraged by the speed with which they were able to alter the existing vaccines to really attack this specific variant?
I was impressed. This is what the value of vaccine platform technology is, that you can plug and play, that you can update the vaccine very, very quickly. What ends up happening, though, is then the clinical trials and all of that is what slows it down, because it takes a while to actually figure out how efficacious it is and what the safety profile is. There are expedited pathways for updated booster vaccines by the FDA. Hopefully those will go into place. But it's really not about the science anymore when it comes to developing a vaccine. It's all about the clinical trials and making sure that people are confident that enough time was taken, that they're going to be willing to get this vaccine. mRNA vaccines just shrink development time down from maybe months to sometimes even days.
Dr. Amish Adalja of Johns Hopkins Center for House Security. Doctor, as always, Amish, thank you, sir. Thank you very much. Lisa, we already got to get our hands around the probability that these banks in New York and elsewhere, the major cities around the world, are going to have a massive push to get people back to the office, particularly in London and New York this coming summer. New York's got a bigger issue, though, and it's crime, and it's making sure that people feel safe to come back to the city, to feel safe to go to Midtown, Lisa, to go to some of those banks. And when you speak to people at the moment that work in the financial industry, it's something they are actually concerned about.
Well, this has been Eric Adams, the new mayor of New York City's one of his main platforms as a former head deputy in the police department here in New York. How much can you give a sense that we are returning to the old New York when this still feels like a New York City that is battered by the pandemic? Honestly, this is going to be a big issue, especially with the revenue hole, as a number of people have moved out and we're still in that transition phase. It's an issue that's facing cities around the world.
It's going to be a big push, Tom. There, you can already feel it.
Oh, it's already there, including Mayor Adams holding a press conference yesterday. And John, what's the immediate thing for me here is the idea of how do we get back to that endemic normal. The metric I'm using, John, and I'm like everybody else, I look at the newspaper every day. I thought the Post and Times do a nice job of this. Deaths right now are 2,100, maybe 2,000 a day. What's the flu equivalent of that? If Dr. Adalja says we need to bring that down to a normal level, how many deaths per day is normal? I've got a number in my head. It doesn't matter what I think, but how do we bring that down, and what to is a mystery.
Looking forward to catching up with Johns Hopkins through the week. Let's get on top of this price action too. Futures down 59 on the S&P. We're negative 1.3%. On the NASDAQ 100, down by 1.9% again. TK, it's got that feeling yesterday, hasn't it? That downdraft in the equity market once more.
I want to report there's some nuances. We're not as locked in and correlated off of Ukraine as much as we were yesterday. John, I would use the metric of the VIX, which with all the 27-point gyration over the last 5 days is up 3 points right now and above the 30 level. And to me, that's the point of tension.
I thought we did the VIX in percentages, Tom, and the Dow in points when we had choppy days. I thought they were the rules.
No, I always use
Make
the
it
VIX
feel
points.
Worse than it actually is.
Oh, yeah. I use VIX
Headlines.
points.
Oh, dear Lord. You're going to use that voice all morning?
Dow futures down 286, down 288 now. David Stubbs at JP Morgan next.
end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
A lot going on right now for the market to digest.
The market is near oversold territory.
The Fed is more likely to be responsive to credit conditions than they are to the S&P 500.
I think it's really what's being priced in is a lack of edge.
I think the outlook for the balance of the year is a bit more constructive.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Here we go again from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market down by 1.3% on the S&P. TK on the NASDAQ, we're down by almost 2%.
On the NASDAQ, in a different character to yesterday before the fun and festivities of Dow negative 1,000 at one point. I'm going to say, John, there's a different cast, but part of it is getting in earnings. And I'm seeing Verizon come up here right now with a modest beat on first glance. But, John, these earnings are not a small issue. Of course, all going to Microsoft this afternoon. And again, it goes to what we talked about in the last hour and this market, which is in every story, there's two different stories. There's two different Fed stories. There's two different company stories out there as well.
Two views make a market, Tom. Dan Ives of Wedbush has this to say: we view this as the most important earnings season for the tech space in potentially the last decade. What do you make of that line, Tom?
I retweeted it. I thought Dan Ives is great. Let's be clear, he's a Super Bowl as a general statement as well. But to me, John, it's the partitioning coming out of the pandemic of who's going to win and who's going to lose. And have David coming up here, David Stubbs in a moment, is really good. John, I just want to say this is exciting. And whatever your belief, I love what Doug Cass said about an hour ago. He says, and John, you alluded to this earlier, Cass channeling Pharaoh. The bulls dig in, the bears dig in, and that's what we got.
And nothing's changed. Nothing's changed. JP Morgan say the bearishness is overdone. Lisa, Morgan Stanley and Mike Wilson say hibernate. Winter's here.
A lot of this has to do with what is the main concern that's driving the risk-off feel. Is it the Fed meeting that begins today? Is it a growth concern with respect to the Omicron variant and just a slowing down in the economy? Or is it simply that people feel like valuations have gone too high? That will define how you view this period of jitters and whether you want to buy or sell.
And that's the market story, Tom. We need to talk about the geopolitics as well. And I know you're not keen to separate the two. The US putting 8,500 troops on alert to bolster NATO presence in Eastern Europe. That's the latest headline in the last 24 hours.
I'm going to link them, John, away from equities. Yeah, I get there's an equity linkage and all that, but I think they've got strong linkage, obviously, in commodities and particularly in oil with the Germany influence. 34% crude oil, I believe, is their call from Russia. But much more in the bond market, John, and watching German 10-year and watching the dynamics here, the yield curve a little bit steeper in the last 48 hours of volatility.
Two stateside back through 1% going into Chairman Powell and that Fed decision tomorrow. Equities down 56. Let's whip through it. On the S&P, we're negative 1.3%. On the Nasdaq 100, we are down by almost 1.9%. Yields are just a little bit higher on 10s to 178. In the FX market, again, the dollar showing some strength in the morning. Euro dollar coming down 0.5%. Euro dollar, Lisa, 112.68.
Yeah, it's been interesting to see the dollar really kind of move around in a range-bound way, given the fact that the Fed is expected to hike rates more aggressively. This is what I'm watching today. At 9 a.m., the S&P CoreLogic Case-Shiller 20-City Home Price Index comes out. How much does it start to decelerate? What does that tell us about rents? There is a big question behind the Fed's meeting that begins today, which is at what point does inflation become constrictive, actually slow growth on its own, and how quickly can it do that? And to that point, at 10 a.m., we get the U.S. Conference Board Consumer Confidence for the month of January, which has been really showing a deterioration in consumer confidence. Part of this has to do with Omicron. Part of this has to do with the base effects. Part of this has to do with the fiscal runoff in terms of checks that are no longer going out. The economic surprise index that Bloomberg puts out has been trending lower. How much is Omicron? How much is something more substantial and longer lasting? And after the market today, Microsoft, the big tech roll of earnings, will release their fourth quarter results. I am just struck by the divergent fates of all of the big tech names. That it is going to be a crucial point, as Dan Ives was saying, to see all of their earnings. How much momentum can they sustain, and how much can they justify valuations that people think broadly, John, are pretty high?
That move in Netflix year to date, just a third of its value. Lisa, a $200 billion plus stock. I mean, it was one. Just unreal.
There has been a big question how much has been brought forward in terms of demand because of the pandemic, and Netflix is suggesting quite a bit because they still are not getting close to the pre-pandemic subscriber numbers.
What a move. You'll hear a lot on programs like this that the Fed is behind the curve. David Stubbs says otherwise. The interest rate market is assuming that the Fed will do more than enough to prevent inflation becoming out of control. David Stubbs joins us now, the global head of cross-asset thematic strategy at JP Morgan Private Bank. David, can you just build on that a little bit more? You hear a lot that line, that the Fed is behind the curve. You look to the pricing of interest rates and say otherwise.
Well, I just think a lot has changed in the last couple of months, John. We obviously had the Fed pivot away from an emphasis on the labor market and the employment to population ratio and participation rates, and move with a lot of hawkish rhetoric to move the markets towards pricing close to 4 rate hikes this year, and close to 7 over the next 2 years. And if you then look at the yield curve 2 years out, it's flat as a pancake, but still slightly positive. If you look at a whole range of forward indicators, they indicate that inflation will come back down roughly towards target. So they've done a lot of heavy lifting here, and the market has priced in quite a significant tightening cycle. And I think the market is also saying that's probably going to be enough.
A little bit south here right now, folks. The Dow negative 300. The VIX out 3 big figures, 33.09. David, I loved your interview about 6 months ago on technology and its effect on society. And within investment strategy and stock selection, what is the risk of ignoring the technological divide? The companies that are technology winners and those that aren't. How do you partition that?
Tom, I think you emphasized one of the great drivers we will see of relative stock prices throughout this decade. If you are either an enabling technology, bringing new innovations into the field, or an adopter, a large company, an incumbent that's really investing hard to bring those technologies to your clients, I think the future is very bright, not just for market share, but also for the net margins. A lot of this technology is about improving the employee experience, improving the ease of customer service. That's the kind of unglamorous stuff that is the root cause of better margins within companies. And I think those that embrace the technology will be able to withstand the significant cost pressures that we're also likely to see this decade from very, very anemic working age population growth in the developed world. In fact, over 60 countries globally are going to see falling working age population. We're going to see faster wage growth. That's probably a good thing for society, but it is going to place a pressure on the margins. Now, next couple of quarters, the margin pressure is absolutely extreme, isn't it? We see wage increases very strong. We see an increase in energy inputs, and now the price of money is rising as well. So there's going to be some companies and industries that will struggle a little bit in the next couple of quarters, but we're focused on those that are going to be able to maintain their margins. And I agree with the statement at the start that this is a very important earnings season. The next 2 or 3 are going to be very important. There will be winners here, and we're looking to obviously exploit those.
Will the winners all be big companies that can actually take advantage of economies of scale? And will smaller companies really fall behind?
I certainly think that today some of the large caps that dominate the market cap indices are high quality in terms of, if you look at their fortress balance sheets, if you look at their earnings profile, their return on equity, they have a lot of the kind of criteria that we put in the quality bucket. But I also think that innovation is rampant in the smaller stocks as well. And especially even looking outside of traditional benchmarks, we have a few strategies we've recently been launching where up to 50% of these companies are outside of MSCI World. And I think that with a forward-looking projection for markets that is a little lower than we've come to expect in the last few decades, investors are going to have to work harder to find that rapid growth. And that definitely includes companies across the capitalization spectrum, and indeed, of course, the private markets, where innovation and technology obviously incubate.
David Stubbs of JP Morgan Private Bank. David, thank you, buddy. It's good to see you, as always. I want to turn back to that quote from Dan Ives of Wedbush, of course, very well-known tech bull. Lisa said the following out on Twitter: "We view this as the most important earnings season for the tech space in potentially the last decade, as the street now needs to hear good news at a white-knuckle time from tech bellwethers, with fundamentals now in focus." You brought up Netflix a few times this morning after earnings getting absolutely battered, Lisa.
Yeah, and honestly, if you take a look at year-to-date earnings and year-to-date, frankly, returns, you can see that the NASDAQ has actually outperformed the S&P 500 by about 2 percentage points. Still, the haven trade is some of these big fortress balance sheets, the Apples of the world, the Amazons, and the Microsofts. However, at what point do we say they can sustain valuations even without Fed support? And that, I think, is where earnings come in.
It's the valuation story, too. And I have to say, Tom, if the stock is down by a third in just a few weeks, then it's not just earnings, isn't it? There's more going on than just that.
I defer to Paul Sweeney on this, so you can join me on another property at 9 a.m., folks. But Sweeney's expert on this. You know what, John? There's a structural war within streaming linked up to the capex that all these people are spending on the movies that you watch all weekend. John, what I would point out, John, is just simple as all get out. Do you look at the balance sheet, as Lisa just mentioned, or do you look at the income statement generation and cash? I just looked at 3M and their cash conversion cycle, and that stock's got a little bit of a pop. You could say the same thing about Microsoft, is what people are buying is less the cash on the balance sheet and much more the ability to earn cash. And then, John, the question is, how far out do you extrapolate to justify the valuation of these wonder companies? And that's what's going to be in play in the coming days.
On this rotation, Goldman's Christian Muller-Glissman had this to say, Tom: "The rotation year to date has been driven by a valuation derating rather than improving growth expectations." Tom, that's the difference between the start of this year versus the start of last year.
Well, yeah, into a Chinese-like economic boom last year, where this year we don't have that.
Tom Keene, Lisa Bravitz, and Jonathan Ferro. Jeff Yu of BNY Mellon's going to be joining us in the next hour. Do not miss that. He'll be with us in about 50 minutes' time. Futures down 1.3% on the S&P, on the NASDAQ down by 1.8. Yields just a little bit higher, 177.60 on 10s. From New York City, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. The Kremlin warns that the U.S. decision to put 8,500 troops on alert for deployment in Eastern Europe exacerbates the tensions. The Biden administration says if the troops are sent overseas, they would help NATO forces in the region. More than 100,000 Russian troops have been deployed near the border with Ukraine. Moscow denies it's planning an invasion. More problems for British Prime Minister Boris Johnson over allegations of those rule-breaking parties during the pandemic. London police are now investigating the claims, and Johnson's office has confirmed that staff gathered in Downing Street to celebrate his birthday during the first lockdown in 2020. A government report on the parties may be published this week. That could add to the political pressure on Johnson. Shares of General Electric are lower today. GE's fourth quarter revenue missed estimates. The company was hurt by supply chain pressures and the effects of the Omicron variant. It's a setback for GE CEO Larry Culp, who plans to break up the conglomerate next year. A new Pentagon assessment casts doubt on whether the U.S. Navy's costliest warship can defend itself. The Defense Department's testing office found mixed performance by the combat system of the USS Gerald R. Ford, a $13 billion aircraft carrier. The report also said the carrier's aircraft launch and recovery systems are poor or unknown reliability. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
What would you like to achieve next in Saudi Arabia?
As you know, Barrick has invested in Saudi Arabia already in a partnership with Ma'aden, the state mining company. And we have an investment in the Jabal Sayed copper mine, one of the lowest cost, highest grade mines around, actually. And we have a real commitment to grow our footprint in Saudi Arabia with a particular focus on the Arabian Shield in partnership with Ma'aden. And so after tomorrow, I'm on the way to the mine. So not only how to be at the conference, but more importantly, to go and work with our team out at the mine who've really done a great job managing the COVID crisis over the last 2 years.
There's a big effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
Season is here.
It has been brutal.
A little bit of disappointment in some of the early reporting.
Nasdaq 100 on pace for its worst month since March 2020.
Bloomberg breaks the numbers first.
Netflix, of course, is the stock of the hour.
A pretty big miss.
This is a mighty crash.
An expert analysis you won't get anywhere else.
The banks is potentially a bad bellwether.
Not only you're not getting incremental earnings growth, you're getting reduction in earnings growth.
What to buy and what to run away from.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We have been consulting with allies in deployments and refining plans for all scenarios. We've always said we would reinforce our allies on the eastern flank, and those conversations and discussions have certainly been part of what our national security officials have been discussing with their counterparts now for several weeks. In fact, we've never ruled out the option of providing additional assistance in advance of an invasion.
8,500 U.S. troops now on standby. Jen Psaki there, the White House press secretary. From New York with Tom Keene and Lisa Bravis, I'm Jonathan Ferro. Equity markets are lower, negative, down 1.3% on the S&P, on the NASDAQ, down by 1.8. Treasury yields not doing much at the long end on 10s, 177.43. Crude unchanged, Tom, 83.33. And in the FX market, some dollar strength for you against the euro. Euro dollar 112.72. That currency pair, negative 0.5%.
For those just joining us on radio and TV, stasis in the last hour is how I'd put it, with less of a correlated tightness as we saw yesterday before all the festivities began. John, what did you do when you woke up from the surveillance nap and saw negative 1,000 Dow points? What was your reaction?
My reaction was, oh, okay, that happened fast. Now what? And then the now what? We filled the gap, Tom, through the afternoon pretty quickly, didn't we?
We filled the gap.
The swing yesterday was unreal, and we can talk about it a little bit more in terms of the data that the likes of Bespoke has put together. But, Tom, to go down almost 5%, to finish the day positive 0.5%,
well,
pretty remarkable stuff.
I take huge value in catharsis in that analysis. And we've, of course, heard some experts speak of their guesstimates of was that catharsis yesterday. I'm not sure. Let us move on right now. And this is really a joy because I will introduce Anne-Marie Horton different this time. She is our Bloomberg Washington correspondent, but in an appallingly young age, she has lent the geography of Europe to her resume, working out of London, going to Moscow, going here. It's all very romantic and all that, except it's mostly plane flights at 9 p.m. and taking the Gatwick Drive into London, which is about as romantic as the drive from O'Hare in Chicago. Anne-Marie, you've got great European perspective. Just as a general statement, as you read the European press, how is Biden, his discussion of Kiev, how is that playing within a Paris or a London or a Berlin zeitgeist?
Well, it's incredibly different across the capitals of Europe. In Paris, in particular, you have Emmanuel Macron, the president, is going to be conducting his own interview. That's what he wants to have a call himself with President Putin. And then, of course, you have French domestic elections, and Marine Le Pen, who's leading quite highly in the polls, said on Bloomberg Television, we should not be talking about sanctions on Russia because that's going to hurt us domestically. You have a quite boisterous response from London, as you've seen from the Foreign Office, as you've seen from Prime Minister Boris Johnson is going to be making a statement on Ukraine, even as he's very much under a lot of domestic pressure. And then Berlin is wavering. They're talking tough at many times. At the same time, they do not want to supply Ukraine with military aircraft, to the point, Tom, that the British didn't even fly over German airspace to deliver their aircraft to the Ukrainians.
Anne-Marie, when we saw the headline of Blinken in Geneva and he talked about an open-door NATO policy, how does that play in Europe?
Well, what comes to mind for me is Finland, just north of Estonia. This is a country that has so many. And Tom, we spent time there together in Helsinki during the Trump-Putin summit. If you remember, Finland in 2014, there was a lot of debate within the country following the annexation of Crimea. Should Finland finally, for once, make the plunge and join NATO? This is something that President Vladimir Putin categorically does not want. The president, interestingly enough, mentioned Finland in a call he had with the Finnish president in his recent press conference. And what did Finland do following this escalation at the end of last year on the border of Ukraine? In the Finnish president's New Year's address, he says, we maintain the option to join NATO when we want to. And right now in Helsinki, there is a lot of support for that, given the measures and the aggressiveness Russia is taking, and not just on the border of Ukraine. We are talking about Russia also talking about war games and those planned in Belarus, as well as off the coast of Ireland.
Anne-Marie, for many years, for several years, we've been talking about the U.S. taking a more isolationist and nationalist approach. Right now, President Biden is trying to put himself out there as a leader of this international coalition. How much has this been informed by what happened in Afghanistan?
You kind of hit the nail on the head, Lisa, in terms of what President Putin wants. President Putin wants that withdrawal from the United States. He does not want a heavy American hand on Europe. And many will point to the fact that potentially Putin is doing this because of that U.S. withdrawal from Afghanistan, because the U.S. wants to pivot to the Indo-Pacific and internally. Richard Haass had talked about this. This is the pivot of the pivot. The U.S. was supposed to use these next few years talking about bolstering its efforts around China, and now it's having to retreat back to Europe. But the thing is that even though President Putin likely applauded the clumsy and chaotic withdrawal from Kabul, at the same time, this did not deter President Putin in 2008 when he rolled tanks through Georgia, or in 2014 when he annexed Crimea. So I think he's just using the calculus of a potentially weakened West in general, not just the United States. There's Brexit, there's Merkel exiting, there's a number of factors.
I mean, John, what's so important here is the reporting of Anne-Marie Horton, including the cigar bar at the Hotel Comp in Helsinki. I think that was important.
Are you revealing what you two were doing when you were meant to be working, drinking and
Tom
smoking
had a cigar.
cigars?
I had an Aperol Spritz. I don't do cigars. That's Tom's.
Aperol Spritz in Helsinki.
I've been there too, Anne-Marie, on tour with Tom, and not much work gets done. Let me tell you. Anne-Marie, just quickly, were you in the news conference yesterday?
I wasn't, but it's the talk of the town, and I obviously saw it. I have a few things to say. I think the president was incredibly frustrated, and he came out and he let his frustration show. And if we're going to call a spade, I think you would have seen that clip rolling, and it would have gotten a lot of heat if this was the former president. And I do believe some of the press also wanted to take that heat up on this current president. But in, I would say, a very adult-like and classy fashion, the president called that reporter from Fox News, and they talked it out, as he had said. And I think he handled himself as well, that reporter.
Anne-Marie, thank you. AMH down in DC, we appreciate it. Citi just publishing, I want to read this quote out in full. It's an interesting one. In recent years, market volatility has been a reason for the Fed to become more dovish. That logic no longer holds when too high inflation constrains monetary policy. While Fed officials will want to minimize sharp movements in markets, a tightening of financial conditions is now the desired outcome. Now, Tom, they conclude by saying the following. If anything, hawkish risk at tomorrow's meeting has increased, given some investors now expect a dovish reaction to the decline in equity prices. That's the game, TK.
It's a parlor game. I'm sorry. I mean, we got Jeff Yu coming up, and it'll be great to dive into this with him.
Looking forward to it. Tom Keene, Lisa Bramett, and Jonathan Ferro. We're down 2% on the NASDAQ, down 1.4% on the S&P. Heard on radio, seen on TV. This is Bloomberg.
Do you think that electric vehicles could reach 10% of the American market by the end of this year?
That's difficult to say, like you said, because it'll be both, not only demand, based on the demand we are seeing for our vehicles, and the rest of the industry is seeing. It feels like the demand is certainly there. But the question will be how quickly can we, all of us, execute to build capacity to meet that demand. And that's what we are very busy doing. Within the next 24 months, we expect to get to about 600,000 battery electric units globally. And that's before our bigger investments that we're making in Kentucky and Tennessee, both for batteries as well as assembly, come online, because they don't come online until about 2025.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I love that line from Citi this morning and Andrew Hollenhorst. A tightening of financial conditions is the desired outcome for this Federal Reserve. In their words, if anything, the risk has now increased of a hawkish tilt to tomorrow's meeting, because most of us expect a dovish reaction to what's going on in this equity market. Just one view out there at the moment. Your S&P 500 is down. It's down again. It's off by 58, a negative 1.3%. The NASDAQ 100 is down by 1.9%. The moves have been absolutely unreal. We've had 6 of these where we've dropped more than 4% and finished in positive territory. 6 of these since 1988, according to Bespoke. Just look at the move in the last 24 hours. It was absolutely brutal. At the lows in the middle of the session, and then bouncing back and finishing positive on the NASDAQ by 0.5%, call it 0.6%. We've talked about this rotation through the first 3 weeks of this year, and for some people it reminds them of what happened last year. Christian Muller-Glissman of Goldman Sachs coming out with a key distinction for me, Tom, and I think it's important. This time the valuation story has been critical. This rotation has been driven by a valuation derating and not a repricing of growth expectations. That's the difference between now and last year, Tom. And you just wonder whether that's the next fear. We talked about it yesterday. You start with inflation, then you move to the policy response to it, and then the growth fears naturally come further down the road.
And it feeds into the multiples on these stocks. With Microsoft this afternoon, John, I've got a PE on a Bloomberg, the DES screen of 35. I've got an estimated out to June of 22 of a 32 level. And on the valuation derating, even the big new defensives, even do they get pulled in, even if they do well?
Some of that driven by what's happened at the front end of the curve. So let's get you the bond market picture quickly. 2s, 10s and 30s. 2s at the moment up 5 basis points, back through 1%. We backed away from that level in the last couple of days, but we're breaching it once more. This curve, though, Lisa, and you've been on top of this, is flatter. It has been flattening over the last couple of weeks or so, and that's an important view. If you believe in that story that growth risks are down the road, and Mike Wilson of Morgan Stanley does, then that's what you're looking for in the bond market.
Although other people will come out and say this market has been so heavily influenced by Fed policy, it doesn't act as the same signal it has in the past. Ask people about yield curve contraction, and you'll get 10 different responses if you ask 10 different people.
Given people expect $1.5 trillion of balance sheet reduction from the middle of this year into the end of next year, Lisa, I'm with you. 10s right now, 177.60. That's the cross-asset price action. Let's get you some single names and say good morning to Romain. Morning, Romain.
Hey, good morning, John. And to Tom's point here about what constitutes defensiveness out there, you keep an eye on Microsoft and IBM, 2 names, at least prior to yesterday, that were really talked about for their defensive properties. We got earnings out of IBM last night. It was about 6.5% growth here on the top line, but the gains that the company made in its cloud business, that provided a lot of optimism here that some of these old line tech tech companies have some life in them. IBM, a low multiple, shares higher here by about 1.7% here in the pre-market. Microsoft going to report earnings after the bell. The shares are down slightly today. They had actually been doing well prior to yesterday's sell-off here. Remember, this is pretty much a cloud-based company now. More than a third of their revenue comes from that cloud division. So any of the structural issues that led to IBM's beat, potentially that feeds into Microsoft. Investors and analysts looking for about 20% growth here for Microsoft. Keep an eye on NVIDIA as well. Those shares down 4% here in the pre-market. Bloomberg reporting that the company may be preparing to abandon that bid to buy chip designer ARM in the face of some relentless regulatory pressure. Man, it's been over a year since that deal was announced. Flip up the board of Flurry earnings coming through earlier this morning. American Express beating earnings about 30%, 29% growth to be exact here on the Amex network in the most recent quarter. They also raised their guidance, projecting right now 20% growth for the year on revenue. That's more than double their previous forecast. Shares only up 0.5%. GE, which of course is splitting into three companies, down almost 3%. The only growth they had was from that aviation business, which is going to be the strongest business. But even with the 4% growth you have there, that was well below what analysts were looking for. All the other divisions had a decline in growth, and a decline that was worse than expected. J&J also a split up here, down almost 2% here on the day. They did beat on a few main metrics here, but investors want to see a little bit more growth there, Tom.
Romain Bostic, thank you so much. And again, the close this afternoon, those important Microsoft reports. Right now, and this is up Lisa Bramitz's wheelhouse, so I'm going to ask one question and get out of the way. Winnie Caesar joins us from Credit Sites. She was with Wells Fargo for years, global head of credit strategy at Credit Sites. And what's absolutely fascinating here is the dynamics and the things we can learn from the credit market, and particularly high yield. There is this phrase, Winnie, yield to worst. We have yield to worsened out, worser now. And as you say in your lovely research note, there's a point where you step in and buy the price for yields to come down or yield to worse to come down. Are we there at this moment?
We are just about there. We had been telling investors that 5% yield to worst for high yield was the level that we thought was much more attractive. And we got there yesterday with the market volatility that we saw. Now, high yield's off to a pretty rocky start to start the year. This is actually the worst January performance on record at this point, worse than 2016's commodity sell-off, worse than 2008 as well. But we think at this point, given the amount of cash that still sits on the sidelines and the need to generate some income in this inflationary environment, 5% on high yield doesn't look too shabby.
Let's take a step back and talk about the credit markets as an important functioning tool that the Federal Reserve looks at. They're not going to get that concerned about the stock market sell-off if you see the fixed income market, in particular credit, behaving. You talk about that 5% level for yield to worst, but if you look at credit spreads, the extra premium that investors charge over benchmark rates, it stayed incredibly tame for the riskiest securities. What's the message that you get from that?
The message that we get from that is that investors should continue to expect a very low default environment this year. Nobody has expected economic growth to really roll over quite yet. And with that, borrowing conditions in the credit markets have remained pretty favorable to issuers, which means that companies are going to continue to enjoy access to liquidity at levels that are still very attractive relative to historic norms, despite the fact that we've seen yields move higher overall. So the price action that we've seen in the credit markets has been much more collateral damage from equity and rates volatility, rather than the credit markets sending a signal that liquidity is really drying up across the financial markets. And we view that as generally constructive.
So, Winnie, fast forward and talk about what this means 2 years from now, 3 years from now, as rates are expected to continue to rise and become more normal, whatever that means. At what point does that become a serious problem given the $1 trillion of corporate debt that have been issued over the past couple of years?
So there is a point where we'll reach this kind of tipping point where borrowing costs very much exceed what issuers can ultimately pay, especially as you point out, debt loads have increased pretty significantly. We're still a far cry away from that. With investment grade yielding about 2.7%, we're still 100 basis points below the average coupon on the index, and that average coupon is at all-time lows. Right. So you still have at least 100 basis points just to get back to that average level. And so long as we keep growth, good enough for credit, as we like to say, then issuers should be able to continue to operate pretty nicely.
I saw a blurb the other day. I didn't even read the whole thing, folks. It was just in the blur of the moment, where it was trying to calculate how much of a debt deal Microsoft could do. Now, Microsoft is the antithesis of your world. I believe they're AAA. They're as far from high yield as you can get. When you hear the ability of any company in your world or in the technology world to raise 10, 20, $30 billion, how do you respond to that size of number?
Well, those sizes of numbers have actually become much more normal to investors over the past few years, where we've seen more and more jumbo deals, both in the investment grade markets and also in leveraged finance. As high yield and leveraged loans have grown, issuers have a lot of avenues to raise very large tranches. I'd also like to point out there is still an awful lot of cash on corporate balance sheets that needs to be used for something. And companies like Microsoft and other very highly rated technology companies are some of the issuers that have the most cash balances. So I'd be a little bit less focused on the size of kind of jumbo transactions that can get pushed through in the investment grade market, whereas the high yield and leveraged loan market are really primed for these massive LBO type issuances over the course of this year.
Interesting.
Winnie, thank you. An important part of the cross-asset story with Winnie Caesar of CreditSights. Important headline just crossed to the Bloomberg, Tom. This one from CNBC. The president weighing curbing chip exports to Russia.
Yeah.
We were expecting a story similar to this one. There's been talk of export controls of some kind. The reporting from CNBC, Tom, the president weighing curbing chip exports to Russia.
Yeah, it's out there. It's been out there, I'll say, for 2 days, John, maybe even 3 days, sort of within the zeitgeist, and maybe before that among people like Mark Gurman or someone like that in Los Angeles. The question here is specificity of sanctions. I didn't get a lot of affection from Dan Tannenbaum, a true expert on that. I mean, are these supposed to work, John?
They're supposed to work, Tom. As you know, Dan Tannenbaum would look to other places around the world and question whether they have. We've had sanctions on Russia. We've had them on Iran, Tom. And what difference has that made to the respective behavior of both of those countries?
I don't know. I look at like the blunt instrument of banning from Russia iPhones. I'm just talking out loud here, John. I mean, I don't know what you do to get their attention if this is centuries and centuries of culture that we're talking about.
Lisa, what do you make of that headline?
It shows how little leverage they actually have right now. That's what it shows to me. The idea that we're talking about possibly restricting chip supplies at a time when you've got a troop buildup on the border of Ukraine, a reluctance to really go militarily and really try to target in a surgical way.
Yeah, ban Doritos.
Thank you. Thank you, Tom.
Thank you, Tom, for that value add.
Thank you.
CNBC in their reporting just moments ago, the president weighing curbing chip exports to Russia.
Lisa's laughing.
And not Doritos. I think Lisa's going to have a word with you.
Oh, you think so?
You think I'm going to be the one to have a word?
I'm in the Bramo timeout chair.
If only we had the Bramo cam for the breaks. When Bramo lets rip on us.
That is just
seriously.
Great.
Oh,
TK,
man, come on.
it just, you come back after a couple of minutes and you just feel beaten up. It's just brutal.
Crushed.
Oh, yeah.
Brutal.
How accurate.
That's why she's so angry when she comes back.
It is.
Am I angry?
Market's going to crash. We're down 314.
I always say it with a smile.
We're down more than 2% on the NASDAQ. We're down 1.5% on the S&P. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden had what he said was a great call with European leaders on coming up with a unified position on Russia and Ukraine. He tweeted that they discussed joint efforts to deter further Russian aggression. Meanwhile, the U.S. says that as many as 8,500 troops could be sent to Eastern Europe to help bolster NATO forces. Another missile test from North Korea. Kim Jong-un's regime appears to have fired 2 cruise missiles towards waters off its east coast. North Korea has test-fired more missiles this month than at any time since August 2019. It's also warned the U.S. it might end its 5-year halt on tests of nuclear devices and the long-range missiles to deliver them. Johnson & Johnson forecast 2022 sales and earnings that beat Wall Street estimates. The healthcare giant is preparing to separate its drug and medical device unit from its consumer business. The drug unit accounted for more than half of sales of last year. Unilever plans to cut about 15% of senior management roles, roughly 1,500 jobs. Bloomberg reported earlier that CEO Alan Hope believes that the number of managers at the consumer goods giant has slowed innovation. The cuts come at a time when activist Nelson Peltz has taken a stake in Unilever. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You mentioned the 1.5 million tests. That's quite a feat. At the same time, I've seen estimates that say that'll get you through about a week or so. What do you do after that?
Let's be smart with our resources. Why not use the test strategically when you need them? How are we using them? A child is diagnosed with COVID in a classroom. We give that entire classroom take-home test kits so their parents can test them, so we can determine if we should close down the school or just the classroom, or what we should do with that particular facility area. What has happened in the past, you had one diagnosis, we want to close the entire school. That just makes no sense. Instead of using our resources in a strategic fashion, the science has shown just because one child has COVID in the classroom, it doesn't mean the entire school or the classroom is infected. We're going to be smarter, and we're going to pivot, and most importantly, we're going to defeat COVID.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The
problem is that the pandemic has introduced certain structural weaknesses into the emerging markets, including high debt levels. Until we get resolution from the Fed as to what it's going to do this week, and especially in March, it feels very difficult to imagine traders jumping back into the foreign exchange and abandoning the dollar.
That was Terry Wiseman there, the Macquarie interest rates and currency strategist. With Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. Your equity market is down 1.4% on the S&P, on the Nasdaq 100 down 2%. Tom Keene, you mentioned Dan Tannenbaum of Oliver Wyman, the sanctions expert. Watching and listening to this program, writing in and saying the following: the US and its allies have a delicate balance here. While yes, Russia has troops built up on the border, since this is a crisis of their own making, they don't have a real rationale to invade. Any real escalation, likely in the implementation of sanctions, would give them that cause, Tom. Speaks to the issue that you were alluding to just moments ago.
Thank you, Dan, for watching this morning, and thanks to all watching on Ukraine. Right now is an important point here. I guess we've got Kriti Gupta with her chart of the day. Kriti, what do you have right now? What are you doing today?
Well, Tom, we got to talk about emerging market equities. We know there's been a sell-off in the developed world. What about the EM? Where is the cash going? And it kind of brings me to my chart of the day here, where you are comparing emerging market stocks essentially to the developed world. And right now, Tom, after 10 years of underperformance, you're actually seeing them outperform, or as Damon Sassower would say, perhaps perform less badly than the rest of their peers. And that's really what brings to my point, because one of the major reasons for people to actually hop into emerging markets right now is because they think that these countries have actually front-run some of the rate hikes that you're going to start seeing in the developed world. Remember, Mexico, for example, was one of the first countries around the world to start hiking rates, and they weren't doing it to target energy prices or commodity prices. Tom, they were targeting food prices, which was their main driver of inflation.
Okay, Kriti, thank you so much this morning. Lots going on here. This is the strength of Bloomberg, to go from Kriti Gupta. And this sounds like a new series on Netflix. John was talking about their content questions from Sassower to you. For the next 30 minutes, you're going to want to stay with us for Jeffrey Yu and his perspective on all that's going on. But now on EM, Damian Sassower, emerging markets credit strategist for Bloomberg Intelligence. Open question, Damian. There's so much going on. Jerome Powell is central banker to the world. Which country is most afeared of that?
Oh, my God. Well, I mean, look, take a step back. What was so important about what's going to happen over the next 2 days is we're going to get some color about runoff here in the U.S. And everybody's talking about, you talked about Citigroup mentioning financial conditions and how important that is. 30-year Fannie Mae current coupon yield spread is 87 basis points. That's kind of what we saw during the last tightening cycle of 2018, 2019. Expect that to rise. Expect that to explode to the upside. We do certainly internally. I was talking with Ira about this just the other day. And so if we get any color to that effect and we see spreads start to move higher in agency MBS, forget about it. What you were just talking about with credit sites, credit spreads are going to blow out, financial conditions are going to tighten, and a lot of the heavy lifting for Jerome Powell may be taken out by equity valuations and credit
spreads. This
is
really important, folks, in the market, because he's talking about, I have no clue what Damian's talking about, but the bottom line is in an EM, price down, yield up. Is there cash out there to step into that in whatever the EM vehicle it is?
Not yet. I think you still need to see real rates rise. Basically, we haven't seen that yet. So, what we're kind of calling for as the second half rolls along, I'm not as convinced that U.S. and developed market inflation is going to come off to the extent of EM, but the inflationary impulse in EM has been so severe, so strong, and the tightening that's happened off the back of that. Remember, we saw Singapore last night. We're going to see Hungary in 10 minutes. We're going to see South Africa, Colombia, Chile this week. I mean, the tightening cycle is there, and we're almost at the end of it. You see curves flattening in EM, which means we're getting into restrictive territory. So at some point, it's going to be a good opportunity to receive, not just yet, and not with the political risk overhang, the elections we just referred to, but at some point, I think it's going to be a good opportunity to receive an EM.
So, Damian, what are you looking for to say, all right, let's go?
So, I need to see real policy rates turn positive, first of all. I mean, look, I think 15 or 16 out of the major 20 emerging market central banks have negative real policy rates, Lisa. That's not a good investment environment. But look, I mean, we do see growth moderating, but not so much. We see inflation falling in 16 of the 20 major emerging markets that I cover. That's kind of a good thing. The extent to which inflation comes off is the key metric here. That's what we're most focused on.
So what are you doing in the meantime? Because people that you speak with are investing in emerging markets. How do you hide? Do you just go to China and you say, well, they're going in the opposite direction, so let's just go with that?
No, I think well, that is one area that I'm going to stay away from that one. That's a loaded question. But look, the market is applying a premium to well-collateralized short-duration cash flows, right? So what does that mean? I mean, it means structured credit, CLOs, bank loans, floating rate notes, all of that stuff should outperform in the current environment. That's not emerging markets, right? So what you do is you basically take a risk-averse approach. We wrote just this morning, I'm going to, kind of tout my own horn here, a low volatility approach to EM credit where you kick out all the high spread, long duration bonds has historically performed well in this environment.
Damien, we don't care.
Nobody cares.
The only reason you're on, Damien, is Rams 49ers. What do you think? After the incredible weekend we saw, like never ever.
I mean,
49ers, Rams, come on.
I mean, I like Matt Stafford. I like Cooper Kupp. I like the Rams in that battle. But look, I mean, far be it from me to judge. Last year during the Super Bowl, I was the outlier who picked the Tampa Bay Bucks to win it all. They were the underdog, if you remember. So come back to me ahead of the Super Bowl. We'll see who's there. I'm thinking we might not have a little bit of an underdog, another situation like last year.
I have no idea what he said on that either. Damien Cesar, thank you so much.
Oh, Tom. You're special. Damien Sassa, thank you very much. Anything else on Doritos?
He bought a place in Turks and Caicos just off Benton.
Who, Damien did?
Yeah, it's amazing. He's a genius.
How much is that?
Did you have the Packers losing?
No, I didn't have that one, unfortunately. My son did, though. My son called that one right.
Your son called that?
Yes, no, exactly. Well, DraftKings is legal in New York. We could talk about, that kind of thing now.
Damien, everywhere I go right now on Twitter, everywhere, it's betting in New York City. Yeah. What is going on there, Damien?
Well, Jonathan, look, I mean, here's the thing. I'm not very good with stocks. I'm not really good with the markets, to be quite honest with you. I only kind of invest in what I know. So, if I don't understand the markets, I'm going to be looking at sports, because I feel I have a better chance there.
What are the odds?
And New York real estate, by the way.
What are the odds that Brady retires?
Oh, God. I thought it would have been higher if he actually won the Super Bowl, but I think now he's got a reason to come back, quite frankly. And, Giselle, I mean, it's really a question for Giselle, right? Because
that's what I hear.
Who's Giselle?
Spoken like a true husband.
No, that is what I hear, that Giselle had to give up a lot of her career in the last 10 years, and Tom needs to get home and do some of the family work.
Can I just sit on something? The fact that the market environment is so uncertain that you'd rather bet on sports, you'd rather bet on football outcomes, says everything you need to know.
I mean, look at this market. Look at the volatility. I mean, the best risk-adjusted bets are in alternative asset classes, sports being one of them.
We can talk about Brazil and Giselle a little bit. Rates in Brazil, 9%.
You're not going to move on, are you?
We can talk about the Brazil elections. It feels like Brazil's been reading on the elections for the last year. No, right. Let's talk about Giselle, exactly.
Let's do that. Damien Sassa, thank you, sir. As always, with Tom Keene and Lisa Bramett, I'm Jonathan Ferro. Bramo says there's something going on in this market. There is. We're down almost 2% on the NASDAQ 100. On the S&P, we're down by 1.4%, conditioned maybe by the massive turnaround yesterday. Lisa, you just don't know what to make of this anymore.
Yeah, you don't know which direction it's going to go in, but you do get the sense people are just searching for the narrative to guide them
Trying to look around corners.
Of course, always.
And really focused on downside risk. 10's at 177. Yields unchanged. Coming up shortly, Jeff Yu of BNY Mellon. Did you say it was genetic?
Yes, it is genetic.
Is it really?
Come on.
estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The Fed's not trying to crush the economy.
My sense is the inflationary boom is largely continuing this year.
What they want to do is not raise rates too soon and slow down the economy.
I very much agree with the phrase that the labour market is tight. I very much disagree with the phrase that the labour market is strong.
We're seeing a slowing down of the economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, deep into 2022 on radio and television. John, exhaustion at hand, a Fed meeting tomorrow.
Yeah, you say deep into 22, Tom, 3 weeks and a couple of mornings. That's how far into 22 we are. And there's a reason why so many people think the Fed can't get it done this year. 4 hikes, the balance sheet reduction, and maybe more. Is that they've done nothing yet, Tom, and we've already seen monster moves in this market.
I got to believe, John, after what we saw yesterday, I know they don't care about the stock market. The president doesn't care about the stock market. Tomorrow's meeting is first, do no harm.
Let Citi do the talking for you, Tom. Hawkish risk at tomorrow's meeting has increased, given some investors now expect a dovish reaction to the decline in equity prices. One of the views out there this morning from Andrew Hollenhorst and the team.
We're going to get through the data quickly here. We're going to look at the tea leaves. But one key tea leaf, Lisa Abramowitz, we just discussed with credit sites is yield to worst. The high yield market shows some of the angst that's out there.
Well, a little bit of the angst, but not that much, not enough, a lot of people are saying, to get the Fed's attention. And this really goes to the point that Citi was making that John just cited, which is the Fed put dead? And frankly, if the Fed put is dead, does the Fed want to give that statement really loudly at this next meeting saying, we are not scared of your jitters. In fact, it is exactly our intention.
We've got Jeffrey Yu with us coming up with BNY Mellon. Let's do this quickly, John. My data check is simple, John. After the exhaustion of yesterday afternoon, it's a different screen than yesterday. I don't see the Ukraine tension on the screen that I saw 24 hours ago.
I see a similar move in the NASDAQ, though, Tom. The NASDAQ 100 down 2%. Yes. The S&P 500 down 1.5% in the bond market. Yields essentially unchanged at 176.89. Interesting you bring up high yield spreads. The pace of the move will always matter, but let's talk about levels. The end of 2018, where the Fed backed away, we were through 500 basis points. Spreads are 200 basis points and change south of where they were at the back end of 18, Tom. Yes, the Fed won't want this to get out of control, but when you look at levels versus levels, we're nowhere near the kind of levels that scared them last time around.
Let's get to it as we've done this morning as well. The conversation on economics, finance, investment is what matters. And in these markets, we are thrilled to bring you this morning Jeffrey Yu, Senior Strategist at BNY Mellon, with a beautiful, holistic dovetailing in of equities, bonds, currencies, commodities. Jeffrey Yu, let's start with an open question. Dow down 1,000 points yesterday. What were you looking at specifically on your Bloomberg terminal?
Two words, real rates. We need to look at where real rates are. Real rates determine risk premium. Real rates infect everything. As long as they're going up, risk appetite is not going to be in a good place.
Can a central bank affect real rates, the present level, the first derivative, the second derivative of real rate movement?
Well, they can affect their headline levels, by massaging things or whatever their communication is going to be at the front end. But the yield curve, has its life of its own. Unless the Fed suddenly announces yield curve control, which I don't think is going to happen anytime soon, I think they should just let the market find the cleared level for where real rates need to be. If they're prepared to push that forward, allow financial conditions to tighten, then so be it. But they've got to manage it. Headline rates, real rates, FX, and equity valuations, these four, they interact with each other all the time. You can't pull all four levers all the time.
Well, Jeff, let's talk about a couple of those interactions. We've talked a lot about the relationship between real rates and equities. Real rates up a lot the last 3 weeks, tech down a lot off the back of it. Real rates up a lot. What has FX done, Jeff? That's the link that's broken down a bit for me. What about you?
Well, real rate differentials, and because especially if you look at dollar versus EM, and I want to be specific here, dollar versus LATAM, dollar versus, say, Central and Eastern Europe, Fed actually isn't ahead. We've just had the Hungarian central bank, 3 minutes ago, surprise to the upside. They're hiking 50 basis points rather than 30 basis points right now. They are managing inflation, hitting hard inflation much more aggressively compared to the Fed. Look at all of what LATAM is doing right now. So this time around, rather than lead, the US is following. One area where this is not happening, Asia, China's real rate problem is actually the other way around. So right now, FX, it is taking on a life of its own. That's why EM FX is still in a good place.
So, Jeff, there's some really interesting trades that emerged from that then. Within G10, within EM, there are all these different things going on, Jeff. Are you saying there's not going to be this broad dollar story through 22?
Absolutely not a broad dollar story through this year. And let's look at what iFlows, our own positioning indicators, are indicating. What does the market want to own? Wants to own Aussie in G10, potential for rate hikes. We saw CPI surprise to the upside overnight. They want to own Brazil right now, one of the best held currencies. Again, real rates going up. You just talked about what elections are good harbinger for the country for this year. They are ahead of the Fed right now. You want to own them. On the funding side, they don't want to own Swedish krona. Rates not moving anytime soon. Swiss franc yen still relatively underheld. So the carry trade actually is still very much alive and kicking, which you wouldn't associate with a risk-off environment.
How much does this get predicated on the idea that it will not be a risk-off environment, that the Fed will do this perfectly, thread this needle, and won't actually trigger something breaking?
I think there are two elements to that. Firstly, some of the more aggressive outcomes out there, such as the Fed selling assets. I think that speak the market a bit, perhaps, but it's being gradually priced out. So in that element, agree, the Fed is going to manage this slowly. But on the other side of it, which is perhaps more problematic, growth. Where is growth going to come from? Yes, the US can still advance with tight labor markets as long as household income holds up. But what about China? What about Asia? This used to be the growth engine that we've had the last 20 years, still struggling more than other places, and with opening up. What's going to happen to the export mix, I think, and what's going to happen to their consumer, to their household, I think that's the missing piece of the puzzle here,
Jeff,
globally.
At what point does the growth story overtake the rate story in terms of China not necessarily being a place you want to go because it is softening, rather than a place you do want to go because they're probably going to ease rather than tighten policy?
So if I look at where Chinese equity valuations are right now in terms of onshore, and also where Chinese real rates are and where the CGB 10-year yields are, it's actually pricing a relatively pessimistic scenario, maybe 5% growth or even weaker. And there are idiosyncratic reasons there. They're not reopening the economy, and COVID and pandemic management, that is not going to come anytime soon. But over the last 2 or 3 weeks, we've heard them talk about tax cuts, further relief. It happened overnight as well. If the Chinese consumer can get to become alive and kicking, and China actually starts its services balance can start to turn things around and start to export demand, then that would be a good thing globally and can complement what's going on in the US right now. Europe, I'm in two minds about right now, being impacted by the Ukraine situation. But overall, I think there is value in Chinese equities, and that's what our flows are showing. People are buying Chinese equities right now.
Jeff, within all the blur of the news and the research, the opinion, our heads are spinning right now. Tom Purcelli has a great thought from RBC Capital Markets this morning, talking about a Fed that wants to slow growth. Is there, they want to slow the good spending story. Okay, fine. Can a central bank affect that? Are we asking too much of central bankers?
Central bank can absolutely affect that if they have the right levers. And I think in the Fed, the BOE, some others, they do, because you can slow growth in consumption-heavy economies by impacting household cash flow, impact their bottom line, raise mortgage rates, raise lending rates. If consumer debt financing costs start to go up, or they're already high in the US and in the UK, then you can slow growth. But the Fed will not try to slow growth, right? The Fed is trying to slow inflation and manage inflation expectations. Slowing down of growth, restraining it, is a byproduct of that, and they want to engineer a soft landing. No central bank will want to engineer a hard landing. Let's be clear about that.
Jeff, just quickly, have you got a UK call, a sterling call off the back of this mess with the Prime Minister?
The mess with the Prime Minister should not impact sterling only until we see a change in fiscal policy. We are bearish sterling right now on the crosses. I see euro sterling higher, but if the national insurance rise is taken away, then the BOE can perhaps hike a bit more, household cash flow improves, then sterling perhaps can recover. So we'll see what happens from number 11.
Jeff Yu, thank you, sir. 134.59 on cable. Jeff Yu of BNY Mellon. Tom Keane, isn't Jeff Yu just everything for the City of London? If people wonder why I speak so quickly, I had to think faster to catch up with people like Jeff Yu, Tom.
It's
just
the
to keep
cadence
up.
of the street. I tell this to people. They say, what is it really like? Because you guys all talk so fast. And I say, you got to remember The Big Short, the acclaimed movie. The way they talk in The Big Short is normal. The way Jeff Yu talks is normal on the street. We all go at a mile a minute.
That real rate story, Lisa, critical at the moment for the equity market. And within foreign exchange, it's subtle, but it's there.
What's driving the real rate story, though? And this, I think, is actually key, because initially, in earlier parts of this epic year that already has been an entire year in 3 weeks and a couple of mornings, as you put it, John, it really was the rate story, the idea of the Fed tightening policy. And then it became a story of declining longer-term inflation expectations. Does that matter as a driver of real rates in terms of what the disruption is in the equity market?
Rolling over a bit here, guys. We're down by 2.5% on the NASDAQ 100, Tom. On the S&P, we're down 1.9.
Just printing 4 big points on the VIX as well. You can look at the Dow down 400, but to me, John, there's a deterioration here in the last 10 minutes as well. John, one of the things that is so important to understand is how delicate you and I have to traipse on the brakes. And, part of the problem here is the investment in engineering and state-of-the-art engineering class at Bloomberg. I mean, we're gifted by amazing technology. And the BramoCam is just one example of it.
I tell you what, if we could get the BramoCam, I think we could get some subscriptions up for this, Tom.
I mean,
You'd be sorely
the
disappointed.
BramoCam is so decked out, it doesn't even frame out in the photo. I mean, we couldn't even get it in, but the tripod is important. It's elegant. It goes back to that 1950s look.
Is that the 1950s, TK?
Yeah, there it is. There's a good shot.
Beautiful.
The BramoCam.
Thank
For those of you
I
on radio,
appreciate that.
the BramoCam harkens back to the 1950s. She documents our every step. And
Lisa, you'd be okay with this, just letting everyone know what you tell us in the breaks, wouldn't you?
No problem.
If it's not with the language used at the White House.
TK.
That was pretty.
That's fiery for you, Tom.
Yeah, well,
Listen.
Okay. Your S&P is down 1.8%. The NASDAQ is down 2.5%. Yields aren't doing much, interestingly, on 10s anyway, at 176.54. Crude unchanged.
I didn't know who Giselle was.
83.80.
I learned something with Damien today.
Euro dollar, negative 0.5% at 112.71.
With the First Word News, I'm Ritika Gupta. The Kremlin warns that the U.S. decision to put 8,500 troops on alert for deployment in Eastern Europe exacerbates the tensions. The Biden administration says if the troops are sent overseas, they would help NATO forces in the region. More than 100,000 Russian troops have been deployed near the border with Ukraine. Moscow denies it's planning an invasion. And more problems for British Prime Minister Boris Johnson over allegations of those rule-breaking parties during the pandemic. London police are now investigating the claims, and Johnson's office has confirmed that staff gathered in Downing Street to celebrate his birthday during the first lockdown in 2020. A government report on the parties may be published this week that could add to the political pressure on Johnson. Verizon has given a signal that free phone promotions and 5G expansion costs aren't hurting the bottom line. The largest US wireless provider beat estimates for subscriber growth, plus it gave a full-year earnings forecast that was better than expected. Shares of General Electric are lower, though, today. GE's fourth quarter revenue missed estimates. The company was hurt by supply chain pressures and the effects of the Omicron variant. It's a setback for GE CEO Larry Culp, who plans to break up the conglomerate next year. Bloomberg has learned that NVIDIA is preparing to abandon its purchase of ARM from SoftBank Group. The company has made little to no progress in winning approval for the $40 billion chip deal. Meanwhile, SoftBank is stepping up preparations for an ARM IPO as an alternative. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
big effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
There are a lot of EVs coming to market, and I'm wondering, do you think that just the market share explodes and there's room for everybody? Or is there a specific market that you're going after right now?
At Vingroup and VinFast is the same way. We're building premium quality products for mass market. And we do expect that there's an irreversible trend to move from internal combustion engine vehicles to electric vehicles. So yes, the market share will expand.
How much money do you think you're going to have to sort of pump into everything right now? You also mentioned, this is an announcement from last year, that you're going to start a factory here in the U.S. Where are you in that? What kind of money are you looking to have to deploy?
So far, VinFast has put in about $6 billion so far into VinFast, and we plan to have a few more $1 billion investment.
Tech company within this environment?
It wasn't that difficult because TravelPerk is doing much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Earnings season is here.
It has been brutal.
A little bit of disappointment in some of the early reporting.
Bloomberg is fastest with the numbers and analysis.
This is a mighty crash.
What to buy and what to run away from.
Bloomberg, the fastest numbers and analysis you trust.
There is a confirmation of unity of the European Union. There is a confirmation to help Ukraine to address this crisis. And also there is a readiness to take measures if necessary and to impose new sanctions, both individual and sectoral sanctions on Russia.
That was Ukrainian ambassador to the European Union with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. And here's your price action, 1 hour and 12 minutes out. We are down about 70 points on the S&P. We're negative 1.6%. The Nasdaq 100 down 324, down 2.24%. Yields aren't doing much. 10's at 177.43. Bramo's got a controller temper, Tom. I'm sure that might be a broken rib.
Yeah.
Seriously. It's too much, Lisa.
Absolutely bad.
Crude 83.41, 83.42. Euro dollar coming in a half of 1%. On that currency pair, 112.70. Moments ago, we heard from the White House Deputy National Security Advisor speaking on CNN in the last hour, Tom, pointing out the troops are ready to go at a moment's notice when NATO decides. This, of course, following the news in the last 24 hours that the US has 8,500 troops on standby, ready to bolster a NATO presence in Eastern European countries, Tom.
Mine was to say, okay, 8,500 troops, I guess, spread from Finland and Estonia down south. What do you do against a reported 100,000 troops of Russia? We go to Alex Bordeaux, who gave us a lot of smarts early in the year with the Eurasia Group, Risks for the Year. We're thrilled he could visit with us again on his expertise of Russia and Ukraine. Alex, I am thunderstruck at the granularity of Eastern troops, think Vladivostok, taking the Trans-Siberian Railway all the way over to Belarus. You don't do that unless it's for a reason. Why does Mr. Putin have Eastern troops in Belarus threatening Kiev?
Well, we have seen other signs of that happening as well over the last few months. Troops coming from Siberia as another example of this. And it does point to a buildup on the Russia-Ukraine border. We now have some of these troops heading to Belarus for these military exercises. And I think that is another part of the pressure that's being put not just on the Ukrainians, but also on NATO and the U.S. To come to some terms on demands that the Russians made back in December that they want a ban on Ukraine's membership in NATO. They want other concessions coming from NATO in terms of troop deployments in Eastern Europe. This is not just about Ukraine, it's also about the threat that Putin perceives coming from the U.S. And NATO on Russia's western border.
Is the threat cultural? Is it the westernization of the Ukraine?
I think that Ukraine's turn to the West, particularly its turn to Europe economically and then to Europe and the U.S. on the security front is of concern to the Kremlin. Historically, Ukraine had been very close, obviously, not just, when we're talking post-independence, there had been very close relationships between Ukraine and Russia. And after 2014, in particular, we saw that really decline. It is, in many ways, a very different relationship now because of the conflict of the last 8 years, because of economic changes in terms of Ukraine's orientation. Putin has been pushing against that over the last several months and sees that as a problem. But I think the security issues really have come up in the last couple of months as being the priority for the Kremlin and the thing that they want the U.S. and NATO to make concessions on.
Alex, I know you don't have a crystal ball, but if you could game out what you think is likely to happen over the next few weeks, what would you say?
Well, I do think that diplomacy has a real chance here. In fact, we think that it probably will, in the end, lead to some level of de-escalation in the coming months. But this is going to be a real challenge, seeing all of the escalation and posturing that we've seen just in the last 10 days or so after the first round of talks really did not go well between Russia and the West. But there are still areas where Russia and the U.S. in particular can have discussions, including on these issues of NATO's presence in Eastern Europe, including issues like missile deployments, nuclear weapons. There's a whole host of things that Putin wants to talk about. Particularly, he wants to talk about them with President Biden and things that a deal could be struck. So there is this room for progress over the next several weeks, but it is going to be slow going, and it is going to be hurt to a certain degree by the escalations that we've seen over the last few days.
Alex, how concerning is it from your perspective that China and Russia are increasingly teaming up at a time when the U.S. is trying to regain its status with the European Union as the alliance?
Well, I think that it is a concern, certainly, for Washington to see sort of this close relationship. I would say that the Russia-China relationship, it's gotten better over the last several years on a number of fronts, particularly economic, but now increasingly on the security side. I think it's unlikely that we're going to see, a formal strategic alliance where one of them comes to the defense of the other in the case of a major conflict, but they will give each other a certain level of support. And in this particular case, I think, the Russians in particular have been they've appreciated the fact that the Chinese government has sort of given a nod towards some of the Russia's security concerns when it comes to the U.S. and NATO.
Got to leave it there, Alex. Thank you, sir. As always, Alex Brideau there of Eurasia. Over in London right now, Tom, the Prime Minister Boris Johnson briefing members of Parliament on the tension between Russia and Ukraine. Of course, the UK and their effort at the epicenter of a lot of this, Tom.
What is the UK position, John? How do they fit in?
Looking to lead in a way that the French and the Germans, as members of NATO, aren't right now, Tom. Germany often seen as the weak link on big geopolitical issues, Russia, China being another one. And I think in this case, Tom, no different.
John, an unfair question. Is a prime minister beholden to Russia for hydrocarbons of any form and shape?
But certainly not in the same way the Germans are, Tom, in a very, very different position strategically, I think, for that reason.
Yeah.
Coming up a little bit later, Glenn Hubbard, the professor of economics at Columbia University, is going to weigh in on this situation in the economy and the Federal Reserve as well. We'll keep you up to speed on the geopolitics too. Futures right now are down by more than 300 on the Nasdaq 100. We're down by more than 2%. On the S&P, we're down by 1.6%. It is brutal out there once again. Lisa, we saw this yesterday. We're seeing it again this morning.
What's driving it? Is this really fears of the Fed trying to get ahead of whatever announcement tomorrow it might come up? Or is this concerns about growth really decelerating? And I think that actually will determine, frankly, which stocks people decide to sell, which people buy, and what the reaction will be after tomorrow.
What's your answer, John, to that good question? To me, the tape is flighty. I mean, it's got nothing, there's no trend here.
It's a continuation of what we've already seen over the last few weeks. We're going into the Federal Reserve. Expectations for them to do a whole lot more was sky high. Then we've had the sell-off in the equity markets. Some people believe that for that reason, the Fed's going to back away. It's all up for grabs tomorrow. I think it's really, really important, Lisa.
Do you think that this is essentially the equity markets waking up to the risk that bonds saw 2-3 weeks ago?
Oh, without a doubt. The valuation derating that we're seeing in big tech, without a doubt. You remember the December 15th meeting, in the middle of December, the Federal Reserve, we came away from that thinking it was dovish. Then it was the minutes that were the wake-up call. And then from 22 onwards, we're counting the rate hikes, 4, 5, 6, 7, 8 from New York. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
From New York City.
We're in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Live from New York City on TV and radio with Tom Keane and Lisa Abramowitz. I'm Jonathan Ferro. It's yesterday all over again. Down 350 on the NASDAQ 100, negative 2.4%. Some new weakness, some fresh weakness to the tape in the last 30 minutes or so.
Yeah.
The S&P 500 down by 1.8%. A bid coming into the long end of the Treasury curve. 10s, yields lower, Treasuries firmer. On 10s anyway, 175.83. And crude with a little lift, the smallest of lifts, up 0.2%, a quarter of 1% higher at 83.50-ish. In the FX market, the dollar is stronger against pretty much everything in G10 this morning. Euro dollar, no exception. We're negative there, 0.5%, Tom, to 112.76.
For Global Wall Street, John, I would watch the persistent dollar that you mentioned of DXY above a 96 level gets my attention. And 2's10 spread, it's in 4 basis points. It's not where it was in the tumult yesterday of 72 basis points, but nevertheless, that's important. Here's what we're going to do, because the schedule has changed. There's a modest Fed meeting tomorrow, and you want to know on radio and television what Glenn Hubbard says of Columbia University. In the meantime, we have to celebrate not just a book, but an important book. So I'm going to do the book right now quickly with Dr. Hubbard before John and Lisa grill him on the present moment and what he would do as chairman of the Fed. Glenn Hubbard, congratulations on a blunt title, The Wall in the Bridge. You minced no words about it. As a Republican policy advisor, there is the wall of Trump and there is the bridge of Hubbard and the bridge required to the future. This is a brilliant, extremely short, concise book. I love what Jason Furman, among others, said about it. Glenn Hubbard, you go back to our best intentions. On page 122, you've got JFK before assassination with great intentions, but LBJ could not implement the trade assistance. He couldn't build the bridge that JFK tried to build. That's just one example. Are we going to repeat a fractured American history?
Well, I don't think we have to. You know, the growth we celebrate always is the heads of a coin whose tails is disruption. And disruption is a demand for adaptation, and the supply can either be walls of protection or bridges like Kennedy tried to do with trade adjustment assistance. Problem is it's too small. In U.S. history, though, we've done it right. Lincoln did it with land-grant colleges. FDR did it with the GI Bill. It's time to think bigger again. That's really the theme of the book. It's really about Adam Smith.
A delicate call, maybe about Donald Trump as well. A delicate question, Dean Hubbard. Can the Republican Party get beyond Trump economics and Trump certitude as defined by the wall and the bridge you'd like to build?
I think both parties can get behind bridge ideas because they're about two simple points. One is preparing people for the world that is and will be, and the other is reconnecting people who get disconnected from an economy in flux. That's something that doesn't have a Republican or a Democrat flavor to it. And in the past, people as disparate as former House Speaker Paul Ryan and President Obama have had many of the ideas I talk about in the book.
One thing that is sort of tying the hands of certainly both Republicans and Democrats right now in spending more money is the inflationary backdrop. How do you incur more debt at a time when there does seem to be a concern? How do you think the Federal Reserve should handle it at the meeting that begins today?
Well, I think most of the programs that I advocate are actually fairly small in spending. That's the shocking political thing, and I describe ways in which we could pay for it. From the Fed's perspective, I think the Fed is behind the curve. It has acknowledged that, in a sense, it is behind the curve and is trying to catch up. The key question is not to add the demand while supply constraints bind. I think the Fed now gets that. The key will be communication and what Wall Street thinks then about stocks and what the economy thinks about near-term growth prospects.
How high can rates go before it becomes a real problem, given how much debt's been incurred, not only by corporations, but by the United States?
Well, actually not that high. Think about it. Even if you shifted the entire term structure of interest rates up by 200 basis points, which is hardly super high, you would have real problems in the federal budget. I think the Fed is independent. It will do what it takes to bring inflation under control. But it is a warning to officialdom in Washington that we have to take the federal budget more seriously than we have.
Glenn, the moment that we're in, as defined by Ira Jersey at Bloomberg Intelligence, is a balancing of a rate policy and a balance sheet unwind. Let's call it QT, which is not an original thought. Are you optimistic that we can do original economics?
I think it's harder than people think. It's certainly academically quite possible. You can do the math and try to count in equivalent rate hikes what QT would be. The problem is QT is not just the opposite of QE. There are a lot of asymmetries built in that we don't have experience with. I think the Fed is taking this very, very carefully.
Does that extend the x-axis? I mean, we had this conversation earlier with the great Claudia Sahm of Michigan talking about Michael Woodford and what we all learned in interest in prices. Okay, great. But is the solution here for any central bank that the x-axis here is much longer than any of us presume and that they will take their time and wait for data?
Well, I think the Fed will certainly wait for data. How much time the Fed has, of course, depends on inflation readings and the reason for those readings. You don't want to let inflation get ingrained into wage bargaining processes. So I think the Fed could wind up moving perhaps even more rapidly than people think.
Glenn Hubbard of Columbia, I am curious for the economics profession what the takeaway is after the Fed got inflation so wrong, and it wasn't just the Fed, it was pretty much everyone. How did it happen?
I don't know that I would call it pretty much everyone. I think a number of economists, I certainly put myself in that boat, said that we're adding to demand, both the Fed and frankly the government too, at a period when supply constraints are binding. So I think this was a policy error that need not have happened.
Okay, so if you think this is a policy error that need not have happened, is it something that can be curtailed by aggressive Fed action, such as what's being priced into the market, or do you think this has longer-lasting sort of influences based on wages, based on rent prices, and some of the other pressures?
I do think the Fed can get this under control. It has all the tools, and it has all the institutional incentives and independence to do that. Having said that, it's hard, meaning that history isn't kind to the view that you could have this kind of Fed tightening without any kind of economic or financial hiccup. So the Fed is walking a tightrope.
Glenn, did this Fed chair deserve a second term?
I think so. I mean, I think Chair Powell acted very vigorously in the coronavirus pandemic. I think the bias would be toward keeping a Fed chair you think is doing a good job, absent some obvious alternative. So I think so. But the only person whose opinion counts there is the president.
And ultimately, the president made the decision to give him a second term. The reason I asked the question is because for some people, he lost a lot of credibility with this inflation call. Are you saying, Glenn, in your comments to Lisa, that ultimately you can win that back and win that back quite quickly?
You can, but it's not without cost. It would have been better had a policy error not been made. But yes, the Fed can win this battle, but I'm afraid we all in the economy are going to pay a cost.
Well, let's talk about those costs, Glenn. How big do you think those costs will be? We have the discussion on this program daily. Some people say soft landing, others say it's too late, recession, inevitable. How large do you think the costs will be?
I would say that the chances are better for a relatively soft landing if the Fed is clear in its communication and everybody understands what is happening. The risks would be if inflationary pressures move faster than the Fed thinks, and it has to move faster, and or there are bad reactions either in financial markets or frankly on the government budget. That's the tightrope I was referring to. But yes, the Fed can pull this off.
So they should look through what's happening on the screens this morning, yesterday, through much of the start of this year, Glenn, with equities down and down hard again.
Well, that, of course, is for the Fed to decide. I don't think the Fed should be in the business of putting a put on the stock market. The question is more, are Fed actions affecting financial stability or economic performance? Those are legitimate questions, and I think they're very much on the Fed's mind.
Important comments, Glenn, as always, and really enjoy catching up with you, sir. Glenn Hubbard there of Columbia University. A Fed decision, Tom, coming up tomorrow.
Big Fed decision coming up tomorrow. Important comments there from Dean Hubbard, who's been, of course, often talked about as a governor, vice chairman, even talked with a certain Republican calculus of being a chairman of the Fed. John, this book is a gentle surprise to me. The Wall and the Bridge, Fear and Opportunity in Disruption's Wake. And what's fascinating to me, John, is the idea of Hubbard speaking for a Republican Party that doesn't have a voice right now. It will be fascinating to see if the Hubbard politics is there in late 22 or in 24.
Are you saying you'd like to see more of an economics vision, Tom, coming from the center?
I don't have an opinion on this. My opinion is that people like Hubbard have been sidelined, period.
Lisa, the classic, I don't have an opinion on it, but here's my opinion.
I don't have an opinion on this, but build the bridges. Look, I think that you ask a really good question going forward for the Federal Reserve. What will the pain be that they inflict? What will the collateral damage be from a tightening cycle after this inflation that we haven't seen in decades? And that, to me, is what we're seeing the jitters pricing in here, the uncertainty of the subsequent slowdown.
And who's going to take the brunt of it? And to go back to what Andrew Hollenhorst and Citi are talking about tomorrow, there is a feeling, and it exists now after this move in the equity market, that the Fed will back away tomorrow, Lisa, because the bar is too high. So at the start of the week, I think you could make the argument, and literally things have changed in 24 hours for some economists on Wall Street. At the start of the week, you could make the argument that the risks were skewed to a dovish surprise because expectations were so high. But given the recent price action, the argument the Citi is making essentially is that now everybody thinks the Fed's going to back away tomorrow because of what's happening right now with the Nasdaq down 2%, the S&P down 1.6%, and therefore we have a risk of a hawkish surprise. I mean, you can tie yourself up in knots trying to work out what's coming tomorrow.
Yeah.
My take is as follows. I'm still not totally convinced that this Fed chair has given up on the essence of transitory, even if it's given up on the word. I've repeated that a few times. And we need to find out tomorrow whether this is a Fed chair ready to break the back of inflation or just ready to tighten up a little bit and wait and see what happens from spring onwards when many people expect inflation to come back down.
Do you think we're going to get the answer to that, though?
He should give us a clue.
You should, as he should get control over the narrative, as Mohammed El-Arian
Can I get theoretical here?
Of course.
Is Tuesday still the start of the week?
Tuesday and not Monday.
Tuesday's the start of the week.
I think the week started yesterday, Tom. What?
Yeah, but today's still the start of the week.
You think this is the start of the week too?
This is the start of the week too.
The week starts right now?
Starts right now.
Okay, thank you for that. Important clarification.
Thank you.
The S&P down 1.6. The Nasdaq down by 2.1. Kate Moore of BlackRock joining us on Bloomberg TV.
She's been on the Bramwell camp.
20 minutes time. She's never going back. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden had what he said was a great call with European leaders on coming up with a unified position on Russia and Ukraine. He tweeted that they discussed joint efforts to deter further Russian aggression. Meanwhile, the U.S. says that as many as 8,500 troops could be sent to Eastern Europe to help bolster NATO forces. Another missile test from North Korea. Kim Jong-un's regime appears to have fired 2 cruise missiles towards waters off its east coast. North Korea has test-fired more missiles this month than at any time since August 2019. It's also warned the U.S. it might end its 5-year halt on tests of nuclear devices and the long-range missiles to deliver them. American Express is putting the pandemic behind it. The company is boosting forecasts for revenue and profit after spending on its cars rose to a record. Amex also is increasing its dividend for the first time since 2019. And Johnson & Johnson forecasts 2022 sales and earnings that beat Wall Street estimates. The healthcare giant is preparing to separate its drug and medical device unit from its consumer business. The drug unit accounted for more than half of the sales for last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
On this sort of idea that growth is decelerating, you know, like so many things, I mean, potential sightings, like UFOs, potential sightings not actually confirmed. I mean, you think about housing, the housing market's accelerating. People are going to be much more willing to finance an asset they think is going to go up in value.
Mr. Dutta fired up yesterday. Neil Dutta with Renaissance Macro, head of U.S. Economic Research, really fired up about the gloom crew, saying, no, it isn't. It got gloomier after Dutta spoke. And then a huge rebound today. Lisa, right now, the Dow negative 300, VIX up 3 big points. Not the same as yesterday, but we're there, aren't we?
We just feel the same kind of jittery uncertainty,
exactly.
the lack of conviction, and you can see that with the NASDAQ leading the way down yet again.
Dollar strength here, 96.19 on DXY. We'll give you more data checks on television and radio through the morning. Right now, this should be a 4-hour conversation. It can be with Ryan Williams, with his experience across institutional real estate, in his own effort with Cadre Partners, backed by all the beauty and the beholden of the investment industry. We're thrilled that Ryan could join this morning. Ryan, I got like 8 questions, but Lisa's got 12 questions, so I'm going to get out of the way. What I see driving around New York, and frankly driving around America, are empty commercial space. And you say, well, it's because of Amazon, it's because of digital. Obviously, it's a pandemic as well. Why aren't the rental prices of that space coming down?
Yeah, no, it's a great question, and good morning. Look, I think that in commercial real estate broadly, there has been a story of winners and losers. And at Cadre, you know, we focus on asset classes we think will be resilient, frankly, that we saw accelerating even pre-COVID. And so we focus on multifamily, industrial, and selectively office. To your question on office assets and vacancies, look, I do think that the calls for the office market being dead were overblown. But there definitely will be assets that are distressed and stressed, specifically those where the landlords are unwilling to put in the work to create greater amenities and to create greater comfort for the tenant base and the like. And so I think a lot of the assets that you're seeing are properties that frankly are either in flux right now because ownership isn't willing to invest to ensure that those properties are highest quality in market, or, you know, they're properties that are being converted, which is another pretty tremendous opportunity, converting office to life sciences, for instance, or retail to industrial space usage. So that's where we see the opportunity, those abilities to be adaptable, flexible, and investing in quality.
Lisa?
Ryan, has the move to the Sun Belt been overdone?
Another great question. We don't think so at Cadre. We've actually been investing in the Sun Belt for about 6 years now. So pre-COVID, you know, we employ not just an institutional investor approach to selections of markets that we think will be outperformers, but we also use data science, which is really one of the differentiated elements of Cadre. And so we've been focusing on markets that we've seen as affordable and high growth for a while. We think that, you know, markets like Phoenix, Charlotte, North Carolina, Tampa, Florida, Orlando, all markets where we have a large presence, actually still have a lot of runway because of the relative affordability. With that being said, there will be some saturation in many of these markets, and we're aware of that. And so we've started to already look for our next Cadre 15. But as long as there's good affordability, good job growth, you know, good access to, you know, amenities, I think that you'll continue to see folks moving for space and out of the urban core and centers into many of these markets. We're still affordable.
I apologize to cut in here, but this is a really sensitive and very important question that I keep seeing asked. How much has institutional investing pushed out individual real estate investors in some of these regions? You talk about the affordability. How much has the institutional push changed that dynamic?
Significantly. Well, that's frankly one of the founding principles of Cadre. It's why I started the business in many ways, because I believe that individuals and institutions should be able to invest alongside each other. There should be greater parity. I saw firsthand that many communities that were being invested in by institutions were changing overnight. People didn't know their neighbors anymore. They didn't know their communities anymore. What we've been able to do at Cadre is build a platform, a technology-enabled platform, where now individuals can invest in quote-unquote institutional real estate.
We're going to run out of time here, and what we're talking about here is a third rail for our listeners and viewers. Steve Schwartzman's going to pony up $1 gajillion, at least $1 billion, to buy 4,000 homes. I can't remember the number as well. Fancy guys like you are taking over the housing and rental business. When does that end?
Yeah. Well, first off, I want to say I'm a fancy guy. I'm from Baton Rouge, Louisiana, out of the institutional world to start a platform like Cadre to level the playing field. But I think it's going to end, when there's greater awareness that the current model is not sustainable, that there has to be greater access and focus on economic inclusion and more broad understanding.
Who's going to police that? The politicians or the market?
I think you'll see a little bit of both, unfortunately, or fortunately, depending on which side you're on. But I think there has to be greater economic inclusion. There has to be a focus on, the community that you're investing in, the impact that you're driving for that community. And it can't just be about profit. It's got to be, there's profits, purpose, because otherwise you'll see a lot of the unrest that we've seen, frankly, over the last couple of years arise again.
Don't be a stranger. Ryan Williams, thank you so much with Cadre Partners. And a third rail topic we rarely talk about. Lisa, I thought your question was great there to start off that discussion. I mean, I'm sorry, this is a third rail topic coast to coast.
You see this with increasing number of institutions buying up not only the multifamily homes that we were just hearing about from Ryan, but also single family homes. The idea that bidding wars are just absolutely taken out of the equation because those homes are just snapped up like that. How much does that push the first-time home buyer out of the market? How much is that a huge driver of some of the gains that we have seen? And how much does that make the housing market insensitive to changes in mortgage rates at a time when the Fed is trying to use this as a tool to possibly tighten monetary policy and crimp the mortgage market growth?
Lisa, we got to go to the markets, down -300. The VIX out 3 big figures, 33.09. I'm fascinated what Microsoft doesn't want to say this afternoon, Lisa. They got $130 billion cash and equivalents as well. I guess they're using some of that. And maybe they're going to go out and do a debt deal 12 hours after they do the earnings report. But they're going to lowball their success today. Don't you think so?
I think it's a real fine needle to thread, just simply because they have to show the dominance of their Azure cloud computing platform. They have to show the momentum there as people go back to person and as people really brought forward a lot of the growth there. How are they competing against Amazon's AWS? Okay, I get your point. At the same time, they have to prove that they're worth the valuations that people have put on them.
Okay, look, the EBITDA margin's 50%, net income, they make 36% on the dollar. It's tough out there.
All right, so you investing in them? Or are you just still
No, I do not. I do not own shares of maybe I do in a 401k, I don't know.
But honestly, I think that they have a very high bar. I think it's interesting going back to what we were talking about, Dan Ives, saying this is the most important earnings season for the big tech world.
Nicely said. We'll monitor at the close this afternoon. We'll give you some love on Microsoft and what we see from other technology earnings into the soiree for the rest of the week. Balance of Power, 12 in today. Wally Adiamo, the Deputy Secretary of Treasury, will join us at 12 noon. On radio, on television, this is Bloomberg. Good morning.
Rising energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Here we go again from New York City this morning. Good morning, good morning. 30 minutes away from the opening bell. Equity futures down hard. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
From New York, we begin with the big issue, major volatility.
Volatility is back. The VIX at 39.
It's like going on a roller coaster.
Panic, sheer panic. Yesterday was one heck of a sell-off.
It's not surprising to me to see these dramatic shifts back and forth.
There is a lot going on right now for the market to digest.
Some of this was repricing. We're having a sea change in terms of Fed policy.
And we have rich valuations on some of these stocks out there.
We're not ready to call the bottom yet. We think you should be buying here.
A lot of opportunity for the long-term investor.
Can we have more of a sell-off?
That's the big question.
Sure, we can.
We've seen a lot of these valuations come down pretty sharply.
And I think going into 2022, we all knew volatility would be up.
That's something to think about now.
Joining us now to discuss is BlackRock's Kate Moore, Clear Harbour's Aaron Kennan, and Zach Griffiths of Wells Fargo. I want to begin with this line, Kate Moore from Wells Fargo and Chris Harvey. The high-volume cathartic puke we were waiting for. It's time to put money to work. Do you agree?
Is it time to dive into the market wholesale? I don't think quite yet, John. I mean, I'm looking for the Fed to actually begin liftoff to sort of usher in an era of perhaps modestly less volatility than we've experienced in January. Like, our base case expectation is that Powell is going to sound a lot more dovish than some of the extremely hawkish economists who've been upping their forecasts over recent weeks and since the start of the year. But that may not be enough to completely calm the markets. I think we have to start to get to policy normalization before we see some of the vol come down. And we really have a great sense for the trajectory of real rates, which in my view is one of the major drivers of equity risk at this moment.
Aaron, what's your take?
Yeah, I think this comes down to, the intersection of where the Fed really thinks the inflation picture is trending. They've abandoned the use of the word transitory, but if you look at the market itself, the market's sort of telling us that, yes, the Fed's going to raise rates maybe 4 times this year and 3 times next year. But if you look at long-term inflation expectations, they're still, trending back towards the sort of historical trend line of just over 2%. And so in some sense, I think the timing of when inflation finally starts to subside and the Fed's view with the market could represent that turning point. So I would argue that we need more inflation indications before we perhaps feel like there's sunshine ahead.
A lot of people would agree with you. For me, what's changed? For the Bulls, not much. For the Bears, not much. Mike Wilson of Morgan Stanley had this to say coming into this week out of the weekend: the end of secular stagnation, financial repression has arrived. It won't be a smooth ride in the near term. Hunker down, hibernate until winter's over. That's Mike Wilson. JP Morgan's Marko Kolanovic, the Bull, says this: the recent pullback in risk assets appears overdone. While the market struggles to digest the rotation forced on it by rising rates, we expect earnings season to reassure. Zach, that's quite a range of views. Which one is it?
Well, I'm certainly not going to disagree with my colleague Chris. I think there's definitely room to put money to work, especially after the big pullback in certain names. I know they like a bunch of consumer discretionary names after this big pullback, but I'd agree that we're moving toward tighter policy, and that's really on a global scale. We're going to hear from the Fed on Wednesday. I think it's going to be very interesting to see how they update their assessment of the labor market, and we think that'll be key to see if they are indeed signaling the go-ahead for a hike in March. That's our call, and we're looking for 4 hikes this year and 3 more next year. So that's generally a difficult backdrop for equities, I'd say, but you've seen financial conditions tighten a fair bit with real yields, but they still remain very loose from a historical perspective, and that leaves room for equities to continue moving at least a bit higher in the near term.
Well, they're moving lower now. On the S&P, we're down 1.5%. On the NASDAQ, we're down by 2%. Bear in mind, we saw this yesterday. Down and down hard. At one point, we were negative more than 4%. On the NASDAQ 100, on the S&P 500, a similar story. Then we saw the biggest intraday comeback going back to 2008. Bloomberg's Katie Lyons has more. Hey, Kaylee.
Hey, John. It was absolutely insane yesterday. That trading range on the S&P 500, about 187 points, which is about 4 times the average. This was a massive intraday move and not entirely unprecedented. We have seen it a few times in history. In 2008, as you said, the last time we saw it. We've also seen it a few times since the dot-com bubble. Those aren't exactly previous times of peaceful stability in the equity markets. And that's not just true for the S&P 500. It's the same for the NASDAQ as well. And historically, after we've seen a big reversal like we saw yesterday, it actually has resulted in losses 1 week later, 1 month later, and 3 months later in the 5 times we've seen this since 1988. Though by a year later, that index actually always has ended up higher. So it becomes a question of where we go from here. And to answer that, we have to consider that yesterday brought just not elevated volatility, but also elevated volume. Actually, volume about 75% above the average over the last 20 days. And sometimes that activity, that much activity, is seen as a sign of capitulation. But we talked about that with Matt Maley of Miller Tabak earlier this morning. And he said, yes, it does look like there was some positioning getting washed out here, but that this could go on for quite a long time. Therefore, he said he would be a seller on rips, not a buyer on dips. And it does seem like we are seeing a bit of a selling of the bounce this morning, John.
Kelly Lyons, thank you. Thank you very much. How does this Fed respond to this? Kate Moore, you alluded to that debate. Let's go there. Citi's Andrew Hollenhorst put out this morning. I'll read it to you all. While Fed officials will want to minimize sharp movements in markets, a tightening of financial conditions is now the desired outcome. He goes on to say, hawkish risk at tomorrow's meeting has increased, given some investors now expect a dovish reaction to the decline in equity prices. Kate Moore, you can tie yourself in knots over this one. How would you interpret that line from Citi?
Yeah, look, John, I think that's fair. There's so much let me put it this way, there's so much data that has come out since the last Fed meeting, and there has been such volatility and so many moves in risk asset markets that everyone's trying to figure out, what is the Fed going to do with all of this information? What I would suggest is it's more likely than not that Powell's going to come out and say, not just that we're data dependent, but we don't have a pre-prescribed path. We are going to continue to moderate our policy as we, take in more data. I don't think that they're overly fussed, frankly, by the S&P 500 falling a couple percent since the start of this year from all-time highs. I don't think they're going to be beholden to their policy will not be beholden to what happens in the equity market. But I do think they're going to be sensitive to some of the weaker economic data and some of the sort of squishiness, I'd call it, as a result of the Omicron variant. So that's what I'm listening for tomorrow.
Just where is the Fed put? Julian Emanuel of Evercore trying to answer that question. He puts the number on it. 23.8% lower. That's the average. The average move of the Fed and the Fed put gets executed at 23.8% lower. Michael McKee, Julian Emanuel of Evercore saying we're nowhere near.
We are nowhere near. I'm not going to sing, but it reminds me of the Carly Simon song. You probably think this Fed meeting is about you if you're in the equity business, and it's not. Let me take you to a chart and spend a minute on it here because it's important to look at. The blue line, the blue area there, that's the S&P 500. The yellow, our Fed rate increases, and then the decrease, the big drop down we saw when the pandemic started. And the white line kind of represents how hard it is to trade. That's liquidity in the S&P markets. And the problem for the Fed is that the market doesn't seem to go down. It keeps going up no matter whether it's hard to trade or not. The Fed's going to care only if you can't trade. But as you can see, we've had this kind of liquidity issue for quite some time in the past, and it hasn't mattered. So at this point, the Fed's going to look beyond where we are. Now, the argument a lot of the hawks are making is that the Fed is behind the curve. Well, if they are, so are analysts on Wall Street. This is the consensus forecast from the Bloomberg survey versus the Fed's forecast. They disagree on inflation in the current year, but look what they see for next year. Everybody thinks the inflation rate comes down to where the Fed is forecasting. This is the median survey for Bloomberg. So the Fed isn't very far off from what people are thinking, and as long as you can trade, they don't care if you lose money, although the market shows we don't these days.
Mike McKee, looking forward to the leadership you'll provide tomorrow through that meeting and that news conference with Chairman Powell. Aaron Kennan, I'd love your view on this as well. I've mentioned this a few times in the last 24 hours. This Federal Reserve has given up on the word transitory. Has it given up on the essence of the argument? Because for most people, they still expect inflation to fade and get back to the twos in the next 12 months.
I don't think they've given up on the argument. I think at the end of the day, if Mike McKee's charts are accurate, we will see inflation trend lower. The Fed cannot control the essence of why headline inflation is high, and that is that the supply chain bottlenecks in the midst of rising demand, particularly the supply chain side of this equation, is out of the Fed's control. They could surprise the market. They could be hawkish tomorrow. They could raise rates 50 basis points. That's not going to fix the headline core inflation problem as it pertains to supply chains. And so I think the Fed knows that. But on the other side of the docket, they also know that fiscal stimulus is essentially somewhat non-existent this year. They expect growth to decline. And, in a declining growth environment where the government's not there and we have midterm elections, which probably will not prove helpful either, I think the Fed's probably extraordinarily cautious and will be so not to be too hawkish tomorrow.
Zach, you get the final word here. Stocks are down and down hard again by 2% on the NASDAQ, on the S&P down 1.5%. Does this screen, this picture, throw in credit to, make a difference to this meeting tomorrow?
Perhaps at the margin, but I don't think it's going to change their messaging with respect to the policy statement. I think they're going to tee up the hike in March. And the point that I would make with respect to inflation, our econ team is well above consensus for 2022 and slightly above consensus for 2023. And I think their focus has been, there are these supply side issues that the Fed's tools are not well equipped to deal with, but the demand side is very strong. And we do have a lot of the past fiscal stimulus still sitting on consumers' balance sheets. So it is time to tighten and start to battle that side of the equation. I don't think 50 basis points is on the table in March. And to hear Governor Christopher Waller say that, I think is as strong an endorsement as he's really on the most hawkish side of things. So we think it's time to start hiking, but 50 basis points is too much too soon. They'll go at a gradual pace this year and next.
Zach, Aaron, Kate, sticking with us. Let's get you some movers this morning. Lots of earnings to get through. Going into the big one this Thursday, it's Apple on deck a little bit later. Here's Abby with more. Hey, Abby.
Hi there, John. Well, lots of earnings to get through. And starting out with one stock that's weighing on the markets, Johnson & Johnson shares are down slightly. This is the company missed sales by 2%, earnings in line. Importantly, though, the full year adjusted earnings is better than expected, pointing to some upside down the road. They also are saying vaccine sales will come in 46% better than last year. With the stock down, though, some investors may not believe them. Now, this is interesting. In such a tough tech tape, IBM up about 0.9%. They beat both top and bottom line. The cloud was super strong. There was a rebound in software consulting. So it seems like the IT budget is still firmly in place. Some analysts even saying that they might meet their mid-digit organic sales estimate. On the other hand, other analysts saying that the turnaround might not be here, but with the stock up again in this tough tape, it suggests that some investors and traders are liking those results, Sean.
Abby, thank you. Coming up next on the program, Ukraine bracing for Russia's next move.
There is a readiness to take measures if necessary and to impose new sanctions, both individual and sectoral sanctions on Russia.
That's coming up next with your equity market 20 minutes out from the opening bell, down 1.5%. This is Bloomberg.
What would you like to achieve next in Saudi Arabia?
As you know, Barrick has invested in Saudi Arabia already in a partnership with Ma'aden, the state mining company, and we have an investment in the Jabal Sayid copper mine, one of the lowest cost, highest grade mines around, actually. And we have a real commitment to grow our footprint in Saudi Arabia with a particular focus on the Arabian Shield in partnership with Ma'aden. And so after tomorrow, I'm on the way to the mine. So not only how to be at the conference, but more importantly to go and work with our team out at the mine who've really done a great job managing the COVID crisis over the last 2 years.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Season is here.
It has been brutal.
A little bit of disappointment in some of the early reporting.
Bloomberg is fastest with the numbers and analysis.
This is a mighty crash.
What to buy and what to run away from.
Bloomberg, the fastest numbers and analysis you trust.
We have been consulting with allies in deployments and refining plans for all scenarios. We've always said we would reinforce our allies on the eastern flank, and those conversations and discussions have certainly been part of what our national security officials have been discussing with their counterparts now for several weeks. In fact, we've never ruled out the option of providing additional assistance in advance of an invasion.
The US preparing to upgrade its military presence in Eastern Europe amid mounting fears of a Russian invasion. This as Ukrainian officials confirm unity within the European Union.
There is a confirmation of unity of the European Union. There is a confirmation to help Ukraine to address this crisis. And also there is a readiness to take measures if necessary and to impose new sanctions, both individual and sectoral sanctions on Russia.
The Russian president continues to deny any plans of an attack. Joining us now from DC is Bloomberg's Anne-Marie, and from Berlin, Bloomberg's Maria Tadeo. Maria, how obvious is that unity this morning?
Well, Jonathan, that continues to be the big question. We know that for months, the European Union said that they were fully aligned with the United States, that we would see massive sanctions on Russia if it were to invade Ukraine. But the reality is the detail, the content, we haven't seen that yet. The new spin is that Europe does not want to reveal those sanctions because it could potentially destabilize its position in the negotiations with Russia. But the reality is a lot of the ambiguity and the contradictions, especially when you look at countries like Germany vis-a-vis Russia, are now coming to boiling point. How can you have a commercial business transaction while at the same time say that you will go after the leadership, that you will go after businessmen, and you will go after some of the big Russian companies? That is a question that Germany will have to answer. And today, that will be the focus in a press conference between Emmanuel Macron here in Berlin with the German Chancellor Olaf Scholz. By the way, Emmanuel Macron says that he wants to get on the phone with Vladimir Putin, hoping perhaps that the French diplomatic body can perhaps decrease some of those tensions.
Anne-Marie, the link in Washington, walk me through it. They've been waiting for the Germans to provide some leadership in Europe on issues like this one. It doesn't seem like it's coming quick enough.
Well, the president met with the European leaders yesterday, and what he said is that there was harmony and they were unanimous in what they want their response to be. But I was just listening to the UK Prime Minister Boris Johnson in the House of Commons, and he got to the heart of what Maria is speaking to, which is a lot of this has to do with Germany. And what Boris Johnson talked about was the fact of Europe, particularly their reliance on Russia for natural gas and as well as for oil. And you have U.S. officials just now hitting the tape, actually reflecting a story that Jennifer Jacobs and I reported exclusively on Friday, that the U.S. is trying to help the Europeans in their concerns by talking to major LNG, natural gas suppliers, that if Russia was to cut it off, that they can go hard on these sanctions because they are going to be able to find ways to fill the hole. But right now, while they are going to show an unanimous and a harmony up front, there's clearly cracks in that unity.
Anne-Marie, thank you. On the latest from DC and Maria Tadeo out of Berlin this morning. The obvious story is the crude one, so let's talk about it. Energy Aspects lifting its Brent forecast to 90. They raised their forecast by $5. Our 22-26 oil price outlook was bullish even before the COVID-19 pandemic, driven by expectation that supply growth would be constrained due to declining capex. That doesn't even factor in what's happening here with a major producer in Russia. Kate Moore, Aaron Kell, and Zach Griffiths still with us. Kate, just the energy side of the story, can you factor in what's happening geopolitically at the moment as well?
Yeah, I got to be honest, John, we're going to try and not get too cute around what's happening geopolitically. But to the point that you were just making, we have been constructive on the energy sector and have actually added a decent amount of risk over recent months. We're actually overweight energy for the first time in the last few years, but being selective around companies that we think not only have that disciplined CapEx, but really, really good management teams that are also thinking sometimes in ESG terms as well. So, you know, I think energy is going to be an overweight for us for most of this year based on the fundamentals, but I don't anticipate us trading too aggressively around the geopolitics.
Zach, Aaron, I'd love your view on this one. I just got a question from a Bloomberg Terminal subscriber. I'll read it out for you both. We'd like to know whether the bid in U.S. debt from Ukraine tensions has blurred the equities market key barometer of where the market's Fed's future expectations are, increasing investor uncertainty and increased equity volumes as the place to express rate opinions. Can you just walk me through how you think that's playing out at the moment, Zach? First to you.
Yeah, that's an interesting take, and I'd say what we saw yesterday was a ton of volatility in equities, and you had a little bit less of that in rates. And one thing that we were focused on coming into 2022 was just how much the correlation between rates and equities had broken down. Now we think that that starts to get back towards more typical levels this year as policy accommodation is removed. But the big thing in 2021 was Treasuries didn't provide as good of a hedge against equities, and you're starting to see that normalize a bit, but it's not as strong of a hedge as it used to be. I think that these recent developments could kind of add a wrinkle there, but in general push things more towards the historical norms when you see equities fall and Treasuries rally, excuse me.
Aaron, can I throw that question at you as well?
Yeah, sure. Interest rates over the last week or so haven't really moved in the long end of the curve as the sort of geopolitical uncertainty between, you know, Russia and Ukraine seems to have actually risen. And so I would argue that the market is paying less attention to this, but we do know geopolitical risks impact markets, particularly in the short term. In the long term, they tend not to. And so, that currently seems to be the theme there.
Aaron, your hedge, of course, depends on what you think the risk might be. Where do you get that safety at the moment?
Excuse me? The risk of the possibility of Ukraine and Russia having
well, not just that, you've got to throw in the rate story as well, throw in the inflation factor into it all as well. What is your optimal risk buffer right now? Where do you find the risk mitigation characteristics in a market like this one with a backdrop like this one?
It's challenging, Jonathan. The sort of concept of an anti-fragile asset, if you look year to date, bonds are down, call it less than 2%. Equities are down significantly across the board, particularly on the growth side. Interestingly enough, emerging markets, a theme we haven't talked about, is almost unchanged. It's almost down. It's only down less than 1% on a year-to-date basis. Now, I'm not suggesting that emerging markets are an anti-fragile asset, but certainly there's a lot of dispersion across equities, credit on a year-to-date basis, but it's all negative. On the energy side, that's the only sector, the S&P 500, that's up and up nicely year to date. We continue to see demand outstripping supply, and we continue to believe that the sort of move towards renewables will not happen as quickly as demand is required. And so we think the underinvestment in oil will continue to be a theme and keep a reasonable floor on the price of oil going forward.
Aaron Cannon, Zach Griffiths, Kate Moore sticking with us. We're going to build on the equity story with Kate around the opening bell. A whole lot more coming up. The morning calls and later. Tech stocks resuming their decline following a major reversal in the last 24 hours. That's all coming up. This is Bloomberg.
the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Two views make a market. JP Morgan's Marko Kolanovic saying the bearishness is overdone. Morgan Stanley's Mike Wilson saying quite simply, hibernate. Once again, equities down and down hard this morning. We're down 2% on the Nasdaq. On the S&P, we're down by 1.4. That's the equity story. Here's the bond market picture. 2s, 10s and 30s shaping up as follows. Yields up a little bit. The front end down a little bit. At the long end, your curve's flatter. 10s right now, 175.29. That's the price action. Let's get to the morning calls briefly. First up, Berenberg upgrading Delta to a buy. $50 price target, highlighting its strengthening balance sheet and the stock's compelling valuation. Wells Fargo downgrading Kroger to underweight, seeing a challenging environment with top-line momentum stalling and pandemic benefits fading away. And finally, KeyBank upgrading Viacom CBS to sector weight, forecasting accelerated subscriber growth with investor sentiment improving throughout the year. Coming up next, Tech in Focus with Microsoft and Apple on deck, why one analyst is calling it the most important earnings season in a decade.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
There's always a risk to overthink moments like these. Citi contributing to that in some ways. My good friends over at Citigroup saying that maybe a hawkish risk has increased going into tomorrow's meeting because investors now expect a dovish reaction to this. Dovish reaction from the Fed they might not get. Futures down 1.5%, down more on the Nasdaq. There's your opening bounce. Switch up the board and get to the bond market. Your 10-year yield shaping up as follows. 10s come in a couple of basis points, 2s go up a couple of basis points. Your curve's flatter, 175 on 10s. In the FX market through most of this morning, we have a dollar stronger story through all of G10. Euro dollar is negative 0.5%. That currency pair at 112.69. In the commodity market, 83.40, up about 10 cents, up a little more than 0.1%. About 20 seconds into this, at the open, your stock market's down 1.3% on the S&P 500. Every single industry group in negative territory. Information technology, as you might expect, bottom of the pile. We're down 1.9%. Energy outperforming as it has done through most of this year. Energy is negative just 0.33%. Some relative outperformance there. We've heard from RBC's Laurie Calvasina warning investors about the return of volatility. Take a listen.
The volatility is back, and it feels like this is a year in which we should get additional volatility. We're having a sea change in terms of Fed policy. Equity investors, frankly, have been behind the curve in anticipating what's coming, so there's a lot of catch up to do. On top of that, an earnings season, which frankly got off to a pretty poor start. So it's not surprising to me to see these dramatic shifts back and forth.
We are down and down again by 1.6% on the NASDAQ, on the S&P by 1.3%. Kate Moore, Aaron Cannon, Zach Griffiths back with us. Kate Moore, let's take it from the top. Want to work through your equity market strategy. You are still constructive on equities for 22. Take it from the top.
Yeah, look, I think there's going to be a tale of kind of two halves in 2022. They're not necessarily going to be sort of equally sized. This first part of the year where, as you just heard Lori talking about, we're going to have significant amounts of volatility. The market, especially equity investors in the market, need to get used to the Fed normalizing policy. And there's going to be a real show me moment for companies as they get through not just fourth quarter earnings, but I would also suggest through first quarter earnings in how they handle rising labor costs, continued supply chain challenges, and sort of broader based inflationary and cost pressures. And I think, the expectations are really high. I mean, companies did an awesome job of dealing with some of these costs and these challenges last year. And so I think the expectations are much higher than even consensus estimates right now. So I think we have this digestion period, and then we're going to get into the second half of the year where some of these challenges roll over, be able to focus a little bit more on fundamentals, and everyone will become comfortable with the Fed continuing to normalize policy. So more vol ahead is my call, John.
Well, Kate, let's talk about fundamentals just for a moment. Do you expect material margin degradation? That was the story through much of last year, didn't develop. Do you expect it this year?
I don't expect in aggregate material margin degradation, but I do think there are some companies that have less control over their costs and less levers to use to kind of manage some of these pressures. One of the things I'm really focused on throughout this earnings season is not just which industries seem to have pricing power or who are able to maintain their margins, but which companies within each industry. I think, John, this is going to be more of a stock picker's year, and there's going to be significant dispersion when it comes to margins over the course of the next few quarters.
Aaron, does any of this matter? A conversation about earnings, a conversation about margins, when it seems like we're working through a material, broad de-rating of the valuation of this market?
Sure. I mean, I do think that it still comes down to, I think Kate's right. I think the back half of the year may provide clarity, but I think a lot of that clarity will be centered around supply chain and inflation, these two dynamics. If they subside, we could see, clarity in earnings. But it'll be interesting to see this week, next couple of weeks, how companies talk about forward guidance. There was some hesitation yesterday on the part of management teams that were reporting last night, even this morning, to provide any incremental guidance going forward, particularly from IBM, as we saw last night. And some of that is idiosyncratic to the company. But I think there's a lot of question around whether or not wages will remain sticky, whether or not margins will contract, how supply chains play out. Consumer behavior in a post-sort of COVID, post-fiscal stimulus world, how are consumers going to allocate their capital going forward, won't be as robust as the market expects. We think earnings will be positive this year, but higher volatility and single to maybe 10% earnings growth doesn't necessarily mean that we see higher stock prices. We've seen a huge contraction in PE in the midst of expectations of higher earnings.
The S&P down by almost 1.5%. The NASDAQ down by, let's call it 1.7%. For more on this one, let's get to Kaylee Lyons. Hey, Kaylee.
Hey, John, we'll add up that 1.7% loss with the losses we've already seen in the month of January, and you get a number like 13% to the downside, setting the NASDAQ 100 up for its worst month going all the way back to November of 2008. All but 10 of the 101 stocks within this index are in the red in the month of January so far. This is a broad-based decline and, of course, spurred by the threat of higher rates, which calls into question the higher multiples that investors have to pay for some of these stocks. Granted, those multiples have come down in a material way given the selling we've seen. What we're looking at here is that blended 12-month forward PE ratio on the NASDAQ 100. You can see those valuations have gone south. We're now sitting around 25 times, basically back to where we were in May of 2020. But even then, as of now, we are elevated relative to history, still about 30% higher than that 10-year average, which is in green. And of course, John, we're going to get more insight on that denominator, the E in the PE ratio this week and next with earnings with some of the earnings from the big tech players. But I just wanted to point out, when you look at those big tech players, they collectively have lost $1.3 trillion in market value so far this year. Microsoft, the biggest loser within that, it's down about $300 billion from the end of 2021, John.
Kelly, thank you. We've got another choppy one today, and if you are delivering earnings right now, you do not want to miss expectations in a market like this one. Dan Ives of Wedbush had this to say this morning. We view this as the most important earnings season for the tech space in potentially the last decade. The street now needs to hear good news at a white-knuckle time. Bloomberg's Abigail Doolittle has more. Hey, Abby.
Hey there, John. Well, probably not included in Dan Ives' forecast, IBM, but that is one company that actually beat, and the forecast is really pretty solid. So as a result, the shares are really being rewarded in this tough tape, with IBM up more than 1% on a strong cloud, software, and IT spending background, whereas the S&P 500 tech index down 1.9%. However, for those big names he's talking about, your Microsoft, which reports tonight, Tesla, Apple, Amazon, on the year, it's just brutal. All of these companies deeply in correction, some of them in bear market territory, and it comes down to just that, the growth. So if we go back and take a look at the growth in the third quarter of 2021, up 42%. For this important fourth quarter that's being reported right now, just 14%, and then sliding into the year. Now, a lot of that has to do, of course, with the big one, Apple. Apple's growth, it is expected this year to be just in the low single digits. What's so interesting here, this chart we're looking at right now, Apple in white, earnings in blue, earnings for this year, even with low single digit growth, $5.73. You can see Apple trending below that. The point is, if they make that low growth number, the stock right now, it's corrected too much, and at some point, perhaps we'll climb back to the trend of earnings, John.
Abby, thank you. 7-8 minutes into this one. It has been a volatile week so far. Monday into Tuesday, the S&P down more than 1% off the lows, but it's early days. Underperformance from the information technology segment of the industry breakdown. We're down 1.6% there. Energy, relative outperformance down just 1/3 of 1%. On the big rotation we've talked a lot about year to date, Goldman's Christian Miller-Glissman had this to say: the rotation year to date has been driven by a valuation derating rather than improving growth expectations. We found that equities tend to digest high bond yields eventually during Fed hiking cycles, as long as the growth rates mix is favorable. But there is the risk that a rate shock triggers a growth shock. Zach, I wanted to come straight to you on this. I was saving that quote for you. Can I get your response to that? The risk that a rate shock triggers a growth shock.
So that's not our outlook right now, but I think it's important to keep an eye on real yields, which we've touched on a bit. And I think those are going to be driven in large part not only by the traditional tightening of policy with raising the policy rate, which I think everyone expects at least to some degree this year, but it's also going to come down to what the Fed does with the balance sheet. And that's something that we're keenly focused on at tomorrow's meeting. Is the Fed going to reduce its balance sheet very aggressively? They had a pretty extensive discussion in December, but really came to no clear conclusions. And several policymakers, including Chairman Powell himself, have indicated it's going to take 2, 3, maybe 4 meetings to hammer out those details. But if they do begin to reduce the balance sheet aggressively, and maybe sooner than we expect, our colleagues in econ look for the rundown to begin in October, that could put a lot of additional upward pressure on real yields, as TIPS seem to be more sensitive to changes in balance sheet policy and that liquidity provision that the Fed has been providing. So that's definitely something that we're going to be keeping a close eye on over the next couple of months.
Zach, what is Sarah House and the team over at Wells Fargo overseeing the Fed saying about the size of balance sheet reduction? I think one thing that stands out for a lot of people so far this year is look at the market, look what the Fed is doing. The Fed's still doing QE. This is happening before they've even managed to even engineer a balance sheet reduction of any kind, in any shape or form. How are they going to do it, Zach?
Yeah, I think they've kind of teed up things, certainly with the discussion in December, and there were a lot of different variables discussed. But like I said, we expect that they will start the rundown in the second half of this year. We expect they'll use caps, kind of similar to what they did last time around, but the balance sheet is so much larger, and the weighted average maturity of it is shorter. So there's a lot of maturing securities over the next couple of years. So if the Fed really wanted to dial things back at a very aggressive pace, it has the ability to do that without doing any outright sales of securities. We still think they're going to be somewhat measured, but they do have the hawkish optionality just by the composition of the balance sheet. So while we expect a more measured approach, we'll be looking for any clues at the meeting today, and certainly again in March when we expect them to hike, to see how quickly or how rapidly they are comfortable running down the balance sheet.
It is going to be a big focus for us all. Aaron, I want to come to you on that first line in that Goldman note, that Goldman quote. The rotation year to date has been driven by a valuation derating rather than improving growth expectations. Aaron, how important is that distinction?
Well, absolutely. I mean, you see consumer discretionary and technology at the bottom of the heap coming into today. I think we're down about 11 or 12% each. Energy leading the way. There's been a huge valuation move. 175 of the S&P's 500 companies are down more than 20%, and a good portion of those are focused on those two buckets, technology and consumer discretionary. Do we have room to run to the downside? Perhaps. I mean, the Fed's walking a very high wire act in trying to balance the expectation of slower growth, less consumer consumption with this sort of pronounced inflationary pressure. This is the question of the moment. I think that's why earnings season is important, and I think that's why we're seeing heightened volatility impacting price to earnings multiples.
Kate Moore, I wanted to give you the final word here. The Nasdaq down 1.8%, the S&P down by 1.6%. You started this show by essentially saying there's a risk of being too cute. There is always a risk of overthinking this, trying to be too smart. We've talked about it repeatedly through the last couple of weeks. The big risk was inflation. Now is it the policy response? And if it's the policy response, is the next risk a growth risk, which essentially is what Goldman is raising with that question. Kate, the risk of overthinking it when you see markets making moves like this one, can you just have the final word on that, please?
Yeah, I mean, a couple times, John, you've given these two quotes from Marco at JP Morgan and then Mike Wilson at Morgan Stanley, and I'm going to split the difference. I don't think it's time to be hibernating at this point, and yet, you know, is some of the market oversold? Sure. Can it get even more oversold? Definitely. But I actually like these periods of volatility, and I mean that genuinely. I really like them because there are some great companies growing revenues 40 to 50%, for example, in the tech space that have derated 30 to 40% since their peaks in November. I think this is a time to nibble, maybe not aggressively, but nibble at some of these high quality stories. So I guess I would say we may not be done with the weakness in the market. As I said, I think we have to actually get to lift off before most of the equity risk can kind of settle. That said, this is a time I want to be building medium-term positions. So I'm not backing away.
Kate Moore, I'd ask you what names they are, but I know you won't give me those names, so
I'm not allowed to talk about that
completely.
On air, John.
Kate,
Yeah.
you can tell me another time. Privately, of course. Kate Moore, Aaron Kennard, Zach Griffiths. To you all, thank you very much. About 14 minutes into the session, your equity market's down 1.6%, the Nasdaq down by 1.8%. Coming up, the president trying to tackle inflation.
What we've seen over the last few decades is less competition, more concentration that literally holds the economy back.
That's next. This is Bloomberg.
Understand that diversity in the boardroom is more than one.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
I signed, as you all know, an executive order to promote competition and build an economy that works for everybody, not just a few. And the competition results in lower prices for families. Competition results in fair wages for workers. And as you all know, competition encourages companies to innovate.
The president tackling inflation and a hot mic, which I should not joke about because we have all been there, Mr. President. The president targeting corporate consolidation, macro policies, Julia Coronado expecting the Fed to go its own way.
President Biden basically blessed the Fed doing what they need to do, calibrating how they need to calibrate, and leaving the judgment call up to them and not sort of hammering or badgering them from his bully pulpit.
Joining us now for more is Bloomberg's Anne-Marie down in D.C. Anne-Marie, walk me through that news conference.
Well, let's just say, Jonathan, just first off the bat, what was so obvious leaving and hearing about that news conference is the president's message on inflation completely got overtaken by that hot mic fiasco. And you can just see, though, that inflation is clearly the biggest domestic hurdle for this administration. And the president was obviously frustrated having to talk about inflation and what it means for his future politically and his party's future with the midterm elections. What they wanted the headlines to be, Jonathan, following that, was that they think that there is too much consolidation. And they wanted to talk about their executive order in July and what that meant so far in terms of the accomplishments they made, including a proposal to go out and get hearing aids without a prescription. And the president made it very clear that this was not an easy fix, an easy win. This is about decades of consolidation. And his quote really was, capitalism without competition is not capitalism, Jonathan, it's exploitation. That's what the president wanted to get across yesterday. Unfortunately for him, it was overshadowed by a hot mic, which, yes, we have all been there.
That's not the quote people are running with this morning, that's for sure. AMH,
no.
Thank you. Bloomberg's Anne-Marie, thank you very much. Your equity market on the NASDAQ down 2.5%, on the S&P down 2.1%. This is the problem for Chairman Powell. The equity market comes in, inflation still elevated. How does the chairman navigate and walk this tightrope tomorrow through the news conference and through this decision? Mike McKee has more. Hey, Mike.
Hello, John. Well, the Fed is going to do what the Fed's going to do, as you guys were just saying, because while Joe Biden could maybe have some long-term fixes, he's got a political problem. Jay Powell has an economic problem, and he's the only one who can fix it. He and his colleagues on the Open Market Committee, they're looking at inflation that is broader and higher than they anticipated, so they're going to announce that they will raise rates, rather. And they will probably mention the idea of going ahead with balance sheet reduction later in the year. But how far do they go? How fast? That's a debate on Wall Street. And I want to show you, Wall Street's not that far from the Fed. You have some really hawkish predictions of what they might do. But when you look at dots go on the Bloomberg terminal, you can see the orange line there and the red line. Basically, that's the OIS, the overnight index swaps forecast for where the Fed is going to be in 2024. It's below where the Fed thinks it will be in 2024. So the markets are saying, going into this,
basically, no matter what the forecasters say, we think the Fed's going to get it right. We'll see how Jay does in the news conference tomorrow.
Hey, tomorrow's a tough one, Mike. Really looking forward to your coverage that you'll provide us. Special programming, as always. Bloomberg Surveillance, the Fed decision coming up tomorrow on Bloomberg TV and on Bloomberg Radio. Your equity market down 2.4% on the NASDAQ, off by more than 2% on the S&P with a sector price action. Back with us, here's Abby.
Not surprisingly, John, with those sorts of losses, we are looking at brutal sector action. All 11 S&P 500 sectors are lower, most of them by 1%. The one sector that's outperforming up just or down just 0.8%. Utilities, that's a true defense. On bottom, not surprisingly, it's all about communication services. Think Twitter, Google, Apple, Amazon, consumer discretionary, Amazon, and then tech. That, of course, is all about Apple. Those declines greater than 2%. On the year, John, I thought it'd be very interesting to check back in on what we have talked about earlier, a couple weeks ago, prior to this massive tech sell-off, and that's the rotation trade. It's still in place to some degree because you have that energy index, amazingly, up 12% on the year, and the KBW Bank Index down less than 1%. On the other hand, the declines for both tech and then another part of the tech index, the chips, the stocks, both down in a brutal way. It's going to be interesting to see whether or not this changes on earnings and then also on this Fed meeting tomorrow, John.
Can we fill this gap a little bit later this afternoon? Abby, thank you. We're down 2.5% on the NASDAQ. On the S&P, we're down by 2.2%. After a vicious move yesterday, lower and then higher to close in positive territory. Bespoke have done some great work on this, coming out with the stats. Here are the stats for you. Monday, yesterday, the 6th time since 1988 that the NASDAQ erased a 4% plus intraday decline to close higher. Here's the important piece, which of course will make people nervous. On previous occasions, the index saw a median decline of 5.5% 1 month later and a drop of 7.9% 3 months down the line. One to think about. Your equity market down more than 2% on the S&P and on the NASDAQ. Your trading diary is up next. From New York, this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
What an interesting Fed meeting we're teeing up right now. About 26 minutes into this one, equities down and down hard all over again. Chris Harvey of Wells Fargo, with some technical language, he called yesterday the cathartic puke you want to buy. It's time to put new money to work. Citi's Andrew Hollenhorst saying that this price action risks a hawkish risk tomorrow for the Federal Reserve because investors believe we'll get a dovish one because of this. you'll go crazy trying to work some of this out. The Federal Reserve is just around the corner. Equities down by 2.4% on the S&P, on the NASDAQ, down by 2.7. Switch up the board and get to the bond market. 2s, 10s, 30s, 10-year yields down 3 basis points, 2-year yields up 2 basis points. That means right now we have a flatter curve. Your 10-year, 173.70. Your 2-year, just short of 1%. That's the price section. Let's get you the trading diary. U.S. consumer confidence coming up at the top of the hour. Microsoft reporting results after the closing bell. A Fed rate decision and Chairman Powell news conference on Wednesday. U.S. GDP and Apple earnings coming up on Thursday. And finally, the employment cost index rounding out the week on Friday. Said it yesterday. Deep breath. Deep breath. This is Bloomberg.
Do you think that electric vehicles could reach 10% of the American market by the end of this year?
That's difficult to say, like you said, because it'll be both, not only demand, based on the demand we are seeing for our vehicles, and the rest of the industry is seeing. It feels like the demand is certainly there. But the question will be how quickly can we, all of us, execute to build capacity to meet that demand. And that's what we are very busy doing. Within the next 24 months, we expect to get to about 600,000 battery electric units globally. And that's before our bigger investments that we're making in Kentucky and Tennessee, both for batteries as well as assembly, come online, because they don't come online until about 2025.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look. in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employer's winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospitalized due to heart failure. Still, he had to attend the 2 branch hearing. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed...
Hello traders, how are you doing today? I'm going to place an order to buy euro at 112.72. Okay, if you're looking to trade euro, here's your chance, 112.72, the price I'm going to buy. All of you guys who got this strategy, please copy this order to buy. If you're following trades, you can copy this order as well, and then you will see if the strategy will work for you. And then you will have to go to website company.co.uk, and if you want, you can purchase the strategy. Okay, I see it's look like we are going to fill the order. I'll speak to you later. I will see when we will fill the order. I'll let you know what we are going to do. Stay safe.
Behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought...
Okay, guys, position opened at 112.72. Stay with me, and we'll close this trade together. And I'll speak to you later as soon. Looks like we will place right now stop on profit, and we will see where it's going to go. Let's see what's going to happen. Let's follow this pair for a couple of minutes. Let's see how far it will go, and then we'll place our stop on profit. Well done, guys, all of you who decided to trade. And I'll speak to you later. I need to restart right now my streamer because the YouTube allows me to stream no more than about 3.5 hours. So please refresh your browser in about a few minutes, and I'll speak to you later, guys. I'll speak to you later. Stay safe.
A southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror